This is Scott Becker with the Becker Business and the Becker Private Equity Podcast. Today, you're going to hear a long recording from our Business Leadership Summit. So this is the Business Leadership Summit. This includes 7 different panels: the deal market, AI for business leaders, talent and recruiting, can ESOPs be a great answer for founders and companies, and then a quick discussion of building great businesses. For the deal market, there's 3 different sessions. So each of those deals with different parts of the deal market. One on business services and healthcare, one on venture capital and private equity, one ultimately on real estate, commercial, residential, and more. 7 great sponsors for this event, the Business Leadership Summit. Those are McGuire Woods, Perpetuate Capital, ThinkSpan, Grange Park Partners, Priority Search Management, Baird and Warner, and Elevate Talent Advisors. We hope you enjoy this long-form program. Please give me comments on it at any time. You're free to reach Scott Becker, founder, publisher, Becker Business Media, Becker's Healthcare, at 773-766-5322. I'd love to hear your comments. Thank you for listening. Our first panel, we've got 4 incredible leaders. We're going to talk about private equity, venture capital, what's going on in the space in the deal market today. I'll ask each of our panelists to take a moment to introduce themselves. We've got about 30 minutes total, so we'll try and keep the pace moving quickly. Bart, one of my long-term partners at McGuire Woods, can you take a moment to introduce yourself? And then I'll ask Jeff and Nader Sami and Paul Slosar to do so too. Bart.
Sure. Thanks, Scott, and thanks for having me as always. Really enjoy these, and hopefully you can say something that's of value. I'm a McGuire Woods lifer. I've been doing this for about over 20 years now, all healthcare, all M&A, all the time. Most of my work is either representing founders on the sell side of transactions or PE funds on the buy side of deals. All in healthcare services, from surgery centers to physician practice management to dental to post-acute care, infusion, wound care, you name it. Tend to be a generalist in that sense, and then also act as outside general counsel for regulatory compliance needs on the healthcare side for strategics as well.
And Bart, how big is the group today, the practice at McGuire Woods in healthcare? And you're located and head up the Charlotte office as well. But talk just quickly about the size of the group today.
Sure. So we're one of the top 5 biggest healthcare practices in the country. We're spread out across the country. We're geography agnostic. I sit in the Charlotte, North Carolina office, but work on stuff all over the country. I've got a meeting tomorrow night in the Northeast. I've got a deal in Texas, another one in California, another one in Michigan right now. So we're really all over the place, regardless of where we sit, and continue to grow out the group. More recently, we've been expanding into pharma and pharma services in a serious way, with 4 recent lateral partner hires over the last 12 to 18 months. And we're continuing to grow in that direction, as many of our clients are interested in that as a step beyond healthcare services into something that has a little bit more exposure to life sciences as well.
Jeff, can I ask you to take a moment to introduce yourself, and what a fantastic career you've had, Jeff?
Yeah, absolutely. Thanks, Scott, for inviting me. I'd love to be an individual contributor and sponsor. That really should have been my current employer, ModMed, which is a software company, but that's where I work now. I've spent a lot of years in healthcare. I've run a dental business. I've run an ophthalmology business. I've run several cancer facilities. I've spent time at a payer. I've spent time at a manufacturer and a couple startups. So I've got the gray hair to prove it. It's a thrill to be on a panel with distinguished people, and more importantly, to listen to the questions that you pose. I think you've got a lot of years in this business. It's an honor to be here.
Jeff, thank you so much. And talk a little bit about, you've got this title of Private Equity Engagement Director, at least one of your titles currently. Tell us a little bit about what you do with ModMed and what ModMed does.
Yeah, so ModMed's a software company. We are in specialty specific areas. So think GI, think dermatology, think ophthalmology, think orthopedic medicine. We're in 12 specialties. It's an EMR PM patient engagement system. So the thesis essentially for ModMed was that if we had conversations with private equity sponsors that are buying practices, that are looking to invest, if we had those conversations and got in at the ground floor around, are you thinking about a tech stack change? How do you think about AI going forward? That the likelihood of us being, married, I think at the early stages would be a lot greater. It's actually morphed into more of a CEO whisper, if I can say it that way. I've spent a lot of time in that chair. Many of the CEOs that I talk to are doing great work. I think sometimes it's not bad to have a friend. It's not bad to have someone that has lived in that space, whether it be PE or privately backed with your positions. I just think it's a lonely chair. And so for me, the role has really morphed in private equity, but then beyond that into really being a connecting point for our company and the CEOs and the ELT of a lot of these big practices.
Fantastic. And you've done a remarkable job at it. Nader, let me ask you to take a second to introduce yourself and tell us a little bit about your history, because you were an M&A person to begin with and then got into business. Talk a little bit about yourself and introduce yourself, Nader.
Great. Thanks, Scott. So, I guess maybe I'll start from the beginning then. Yeah, I started life as a corporate finance attorney, then moved into investment banking in New York and San Francisco, and ended up leaving that to start a company which we built up and sold, built up to about 2,500 people and sold. And then I acquired a company at the time called National Medical, which is today Nimble. I ran it as CEO for about 14 years. We did a recap with a private equity firm. I ran it for about another 3. We did 4 acquisitions in that time frame. And then I transitioned over to executive chairman about 2.5 years ago. And we've done a couple more acquisitions since. So to your point, yes, I've been involved in and around the M&A world, from different angles throughout my career.
Thank you. And full disclosure that Nader is a very, very close colleague for a long time. I've had the pleasure to serve on one of his boards of directors and just as good a leader as they come, Nader Sammy. So Nader, thank you so much. And we're thrilled and honored to have you here with us today.
Thank you, sir.
Dr. Slosar, Paul, you probably have one of the most interesting careers of anybody. Tell us a little bit about your career and what you do today in terms of investing and so forth, Paul.
Thank you, Scott. So I am an orthopedic spine surgeon by training. I practiced 28 years in the San Francisco Bay Area, ran a private academic group, and was very fortunate to have been in the Bay Area, both to have been in the Bay Area in those times when things were growing and somewhat still affordable, but secondarily, to have seen the really dramatic rise in opportunities in orthopedics and spine. Given where I was geographically and the sort of the visibility of our group, I was doing private equity, venture capital due diligence. During my whole career, I worked with 4 different companies over the 28 years that I practiced, with 4 different companies that had successful exit, everything from being a strategic advisor to an 11-year run as a chief medical officer for Titan Spine and a strategic advisor to Relievant that exited to Boston. I decided to go back to business school a few years ago. I got an executive MBA and then pivoted into the consulting and venture capital space. So I co-founded a venture fund. We just closed it, a very small seed stage fund aimed with a kind of a dual mandate. One is to, in an organized manner, leverage clinicians, physicians, healthcare executives, all of whom are various aspects of our limited partnership. And then number 2, try to address the gap in a relative gap in clinically intelligent early stage investing, seed investing. So we're sort of sitting in that small spot there, and we've deployed into 3 companies so far, and we just literally closed the fund about a week ago. So we're getting ready to fully switch into deal deployment mode right now.
Well, congratulations on your career and what you're doing. I'm going to ask each of the following question really is, what are you seeing in the deal market today? And I'd love you each to answer from your own perspective, whether it's the venture world, the PE world. Obviously, one serves as executive chairman, one serves side by side with the CEO in their company. Bart sees a whole number of different things and also serves as an advisor to several companies, and Paul's an investor. Paul, I'll start with you and go back around the horn that way. Paul, tell us, what do you, in each person, just think about a minute to 90 seconds each. What are you sort of seeing in the deal market today? Is it hot,
Sure.
cold? What do you see out there?
Well, again, with the caveat that I'm viewing the world from an early stage seed healthcare investor perspective, deal flow is strong. That's really not a problem. We're seeing, and we've aimed at as two aspects of our investment thesis: women's health, which has been undercapitalized for quite a while, as well as the operational efficiency tools that are really significantly underrepresented in healthcare. So tools that are genuinely helping deliver better care, not so much the clinical, but the operational side. My whole world, primarily, or three-quarters of my world, was in the device space, orthopedics and spine, as I mentioned. That's a pretty mature market now. Not to say that it isn't, there's not opportunities there, but we're definitely looking at areas of deal flow, inbound deal flows that include workflow, supply chain, clinical care, and I mean everything from scheduling tools to the AI decision-making tools that clinicians will use in women's health.
And Dr. Slosar, anything that you're particularly excited about? Is there one area, one company you've invested in, or anything that you're particularly excited about in terms of the areas that you're looking at?
Yeah, in the three investments we've made, I'll talk about one and we can touch on it later. But the things that are in the revenue cycle management, I know that's a crowded space, but it's so fragmented and so confusing to the average customer, the average patient, the clinicians who provide that care. The opportunities in revenue cycle management that bring a organized and cohesive platform, one of which is one of our investments, which is called Clear Health. One single point of solution for the entire exposure of a patient's out-of-pocket deductibles. Usually you have to adjudicate those as a patient across all these providers, hospitals. So things that bring cohesive organization to revenue cycle management and drive revenue is a good place to be, in my opinion. That's the one that I'm really excited about so far in our portfolio.
Thank you very much. And fascinating what you're doing, and what a fascinating transition. I wish we had more time. So we'll talk about the transition from orthopedic spine surgeon to investor, and what that is like. Nader, I'll ask you to talk about something similar. First, what are you seeing in the deal market today? I know you watch it really, really closely, from being a deal professional a long time ago to being heavily engaged in deal activity today, and watching what others doing, competitors are doing, investors are doing. Well, what are you seeing out there?
So I think the most interesting change that I've seen in the last year is, I kind of refer to it as almost an AI screening framework. And it now we live in the HCIT world. So in this world, step one is investors are really looking at the industry broadly. They're taking a step back before even looking at the business, and taking a step back and saying, is this business going to be here tomorrow? Is it going to get disintermediated by AI? And then, looking at what moats does it have, what expertise, et cetera. So assuming you get past step one and the conclusion is, yes, we think this business will be here tomorrow, given its expertise, its knowledge, et cetera. Then, step two becomes, what will be the impact on that business? So if you have call it a $200 million company, and you fast forward that same business, assume no growth, that same business, what does that top line look like? Do you lose 20, 30% of revenue due to, different pricing structures with the emergence of AI? However, if that happens, what happens to, your margins? Maybe they go up, maybe client retention gets better. So it's trying to understand the impact. So the first two questions almost are industry, what's going to happen. And then once you kind of get through that assessment, then the third one is, okay, now the company we're looking at, where are they in their AI journey? And are they in position, are they early stages? Are they, behind? Are they in the middle of the pack? Are they ahead of the game? Are they positioned to win? Are they going to back the folks? Or maybe alternatively, it's an investor who has their own conviction around AI and a team, and maybe can come in and get into a deal at a bit lower price and then apply AI later. So really interesting discussions that probably even 6 months ago weren't happening at the level they are today.
It is fascinating to watch the impact of AI on people looking at deals and trying to explore deals. I saw a recent headline today: Microsoft CEO Satya Nadella which has been the software powerhouse, business software powerhouse forever, really talking about how some of the AI powerhouses might have an unfair advantage at some points and some of the challenges they will face, which seems ironic from sort of one of the top companies of all time in terms of market cap and size, complaining about what AI might do to their business and sort of taking shots at it. I thought it was fascinating. But also recently was in discussions with a software company that's having a hard time selling right now because people are very unsure of what margins are going to look like and the business is going to look like in the AI universe. And so that becomes a real issue as everybody looks at things. Jeff, let me turn to you. And what are you seeing out there in the deal market today? And are you seeing opportunities? What do you see out there?
Yeah, it's not the position you want to be the third of the panel with the same question. But I'll tell you, it's interesting. Paul hit on a couple things that I want to multiply a little bit. And I come from a lens of an operator. So I've spent my time at practices and at healthcare technology companies. I went to a conference a while ago and somebody walked out and said, "Wow, let me write that down. You got to have good operations." I'm not so sure that this is like the new in vogue thing. You have to have good operations, and you've had to have them for the last 55 years in healthcare. But what does that actually mean? Good operations means that you are taking redundant and mundane tasks and you are doing them faster and better and more efficiently so your staff can actually do something that does one of two things. Either allows the doctor to see more patients or spend more time with his patients, or there's an ROI. So if you're not doing those things, I think you're really a business that is ripe for a consultant who comes in and says, "Wow, you want to sell, but you're nowhere near ready." So I see, Scott, a lot of people thinking they're ready to go to market, but they're not. And they have, this vision that I can get 15x on my existing EBITDA, and they really aren't even close. The other main point I'd make, and this is a stat that I think is so telling, and it speaks to what Paul and Nader talked about for AI. So since 1970, so a while ago, the number of physicians in healthcare has increased by about 150%. So more physicians. We still have a massive shortage, but there's an increase in physicians. Makes sense. In that same period, 1970 to today, there's almost a 4,000% increase in administrators. So, what do? That doesn't mean you fire a bunch of people. What that means is you have to find a way to, as I said earlier, get the doc more time with the patient. Sometimes that means seeing more patients, and find a way to have an ROI. So I see people that can do that, whatever, it's a PPM, it's a health tech company. If you can do those things, there's a great market for investment. And the numbers would reflect that. If you can't do those things, you better figure out a way to do that if you want to have some kind of exit. So it's really I think it's a great time, but you got to be pretty clear about what you're doing in those areas.
And I love that concept. You better have true sort of like, you could call it product to market fit, or truly something that does something that makes some value, it adds some value. It's I think a great point. Your point on operations is so well taken. That stat, 150% increase in doctors, 4,000% increase in administrators is a frightening and daunting stat. That's an insane stat, and I know a true stat, but that's literally remarkable. Bart, what are you seeing in the deal market today? You see it from a bunch of different perspectives. Very busy deal market. Obviously, at the top of the public markets, it's crazily busy. But what about in the private equity VC world? What are you seeing?
Sure, and I'd agree with what Paul said earlier from the VC side, that deal flow is still very strong. There are still opportunities out there. There are a lot of opportunities coming across the desks of the PE funds. What we've seen is they're being more selective, though. Gone are the days when there was sort of a gold rush around healthcare services, where we would see people coming to us, "Hey, we've got a healthcare deal we want to do," and we're having to do a lot of education from ground zero, because there was a lot of what I'd call tourists in the healthcare space. I don't mean that in a pejorative sense. It's just funds that weren't really dyed-in-the-wool healthcare investors. They're trying to diversify into or try to catch the tailwinds associated with healthcare services consolidation. We're not seeing that anymore. What we're seeing is more dyed-in-the-wool healthcare investors. It's a central part of their investment thesis. Those funds are still doing very, very well, and they're picking their spots. They're not putting a bunch of chips down. They're being very disciplined about their investment theses, and they're executing. Those are the ones that are doing well today. They're still doing well. The ones that have done less well, and we have seen quite a bit of distress recently, and I'd say that is a development within the last 12 months. We're seeing more and more either PE fund clients come to us or founder-backed companies, primarily PE-backed, or companies or platforms that have been through one recap or two, that are having challenges hitting their loan covenants. They're looking at maturity dates coming on a lot of their debt. So they're either looking to refinance out of that or to cut a deal with their lender. So we're seeing some creative deal structures come around those. That is a real trend and definitely something to keep our eye on. But it is separating the winners from the losers. I think there are plenty that are still doing really, really well, but there are some that are showing signs of cracking, and they're going to have to do something. I think the reason we haven't seen more on the exit side of the PE-backed platforms is they're getting good returns, but they're not what they want. So they may be getting, a 2 or 3x on their investment, but not a 4 or a 10. And so a lot of them are playing the waiting game. They're being very patient about when the right time is to exit, and they're looking beyond just dollars and cents into deals where they can keep some chips on the table. We're seeing more and more funds retaining rollover equity into post-transaction. We're also seeing continuation vehicles, and we're seeing continuation funds where they still think that they've got more room to go on their existing investments. So we've seen a lot of that happening too. But within that backdrop, or against that backdrop, we're still seeing quite a good number of really successful, good, big exits on the private side. And the private markets still have an appetite for those deals, both on the buy and sell side. So we're, at least at the firm, anecdotally, we're having a very busy year.
Thank you so much, and fantastic. So we've got about 7-8 minutes left. I'm going to ask each of, and Bart, we'll have you on the next panel as well. So Jeff, Nod, Paul, I'm going to ask you each one of the next 3 questions. I'm going to start with Jeff, so I don't have to hear him be upset with me for asking the same question that everybody else has asked. So Jeff, I'll start with you. Where do you see, I'll give you the question of what separates companies that attract strong investor interest from those that struggle? Where do you see sort of companies that there's a lot of interest there? Is it management? Is it cash flow? What drives strong investment interest where compared to those that struggle in getting investor interest?
Yeah, so I think if you asked this question 10 years ago, it's the exact same answer. And I don't want to be coy about that or glib about it. I mean, let's look at what a good healthcare business is, and it's probably universal to other businesses, but it's a simple formula. It absolutely does start with the management team. You cannot have a good management team, a good company without a good management team. Management team is not just administrators; it's physicians as well. And I'm not saying that because Paul's a physician, but it's absolutely that combination. So it starts there. When we talked earlier about AI and we talked about your roadmap for those things, I think that's a whole session in itself. But if you don't have specifics around how you are putting an AI tool into your business, you don't have that actually mapped out, I don't think you're very attractive. I think that's a big part of it. And I'd say one other key point there, there's a bunch of point solutions, which is to say, I'm going to bolt it onto my EMR. Warning here, but I work for an EMR company right now. We see us having a moat around all those things. And wouldn't you rather, out of practice, have those tools within the EMR versus bolting it on? Whether it be RCM, to your point earlier, Paul, or it is a voice AI component, that's best served when it's done internally. So that's a key point. The last thing I'll tell you is the space. Which one are you in? Are you in GI? Are you in women's health? Are you in dental? Are you in health tech? Many of those things start with the slide that says aging population. We can have more patients. Everybody has that first slide. But what does that mean? Are you actually able to attract people that are not necessarily insurance dependent? You've got a different level of cash flow. You can put yourself in a position where you can see the next 5 years. Look, those metrics aren't new. That story isn't new. It's the same we've had 10 years ago. I just think, as Bart said, there's a lot more scrutiny there is today than there was, I don't know, even 3 or 4 years ago.
Thank you very, very much. Nader, let me ask you this question because you spend a lot of time in these areas. Where are valuations holding up best, and where are you seeing buyers be more selective? We talk about a lot around healthcare technology, around software, around labor heavy businesses. Where are you seeing valuations hold up, and where are buyers becoming more selective?
I think part of it is kind of think about the kind of that three-step process I talked about. One, you've got to kind of get through that from an AI perspective to sort of be interesting right now. And then, one of the things you'll hear a lot, whether it's investment bankers or investors talk about, is the rule of 40, the rule of 60, et cetera. And so I think a lot of people are, and again, much more stringent on that, whereas maybe, again, a year ago, companies that were a little bit lower on that. And by for those who don't know what that means, rule of it, take your growth rate plus your EBITDA margin equals 40 equals 50 equals 60 equals whatever that number is. And kind of that threshold is right around 40, I think, today in an HCIT world, where to make companies sort of interesting. And the more you can get up to 50, 60 and up, and some investors are going to lean more in toward the growth side of that and some on the profitability side. But I think being able to, showing those demonstrated financial performance, and just a quick subset of that, and I'll be quick on it, but that breaks down to, high quality revenue, recurring revenue with high client retention is really important. The growth rate of the historical growth rate of your revenue plus a solid pipeline to show that that's going to continue, a proven ability to grow in a profitable way, and then finally the AI discussion. Where are you in that AI journey? So I think it's that combination. Where do you kind of fit in that rule of, and what comprises it, with those points I just made, and the ones that are going to, right now perform better. I think it's a market that it's really kind of bifurcated. There are going to be winners that are going to get premium multiples today, and there are going to be a lot of deals that sit and don't get done.
I think that bifurcation is exactly right. And Nader, thank you so much. Paul, let me turn to you. We've got a couple minutes left on this session. Looking ahead 12 to 24 months, biggest opportunities and risks for investors and founders. Where do you see the biggest opportunities for investors?
Well, I think, Scott, there's this convergence. Obviously, everybody's talked about it. I'll echo it again. This AI-driven opportunity to finally, technology in medicine has been EMRs that have been poorly designed and usually poorly adopted, but clinically relevant AI-driven support tools, and I mean operational and clinical. And then I'm also sort of sensing there's a couple of things. The days of big employment, the days of these private equity roll-ups of orthopedic groups, et cetera, the days of all the hospital systems going up and buying all these practices, I'm seeing a little bit of a wall there. And I really do think value-based healthcare regulatory forced onto the market is increasing with MA plans, and secondarily self-funded insurance opportunities where really highly efficient platforms can help primary care all the way up through the surgical specialties. The platforms that close the loop between what would be a surgical outcome and a financial outcome, I think, are opportunities. And then the risk that I see, there's also a talent risk. Some of these operating or engineers, the AI scientists, the clinical informatics specialists, they haven't necessarily been attracted into the ecosystem of startups or healthcare in and of itself. So the talent needs to be in healthcare from a systems perspective, data engineering, data scientists, and they have a lot of choices. So we're paying careful attention as we diligence companies. To Jeff's point earlier, they have to have domain expertise, clinical relevance, but also we're curious about what's their plan for their data and who is their data team, as it were. We do start to look critically at that, but I see a lot of opportunity to be quite clear in this resurgence of private practice and direct to employer contracting, self-funded companies that are sick and tired of 18% premium increases a year.
Paul, thank you so much. I want to thank all four of our panelists. There was somebody who mentioned about the 1,100,000 physicians versus 345 million people. And for whoever did say that, we couldn't agree with you more if that's the point, that we've got a daunting shortage of physicians versus compared to our population. And that's a whole nother subject and discussion, but we think that is a daunting problem. I want to thank Bart, Jeff, Nader, Paul. Jeff, we'll have you back on in a little bit. Bart, you'll stay on for this panel. And let me thank each of you and welcome our next panelist to our panel on the deal market, business services, and healthcare. I'll ask, there we go. We've got that group up, Jeremy Jacobowitz, Tom Malin, and Bart Walker. We'll walk through again several questions. I don't know if we have Jeremy with us yet. Jeremy, if you could flip your camera on, that would be great. Thank you so much. And Tom Malin, I see you there as well. Let me ask each of you to take one moment to introduce yourself. Jeremy, thank you so much for joining us. Take a moment and introduce yourself and tell the audience what you do.
Sure, will do. Thanks, Scott, for having us on. Excited to be here today. I'm Jeremy Jacobowitz. I'm the founder of Range Park Partners. My firm provides M&A execution services, so we'll support middle market businesses and investors that are going through a transaction process. We'll act as an outsourced deal team or an investment team, really, for a business that's making an acquisition, or for a business that's going through a sale process. We'll help recruit the right advisors. We'll help run the due diligence process and just manage the day-to-day execution of a transaction from start to finish.
Thank you so much. And Jeremy, just take a moment on how you got into that business, such a needed piece of that business, particularly in the lower and middle market. Talk about how you got into that.
Sure, happy to. So I've spent my whole career in the M&A space myself. So I started my career as an investment banker, then worked for a number of years at a private equity firm. I ended a family office doing private equity deals. And the one common theme that I saw on all the deals that I did as a private equity investor was there are a lot of great businesses out there in the middle market and lower middle market in particular that are run by very talented entrepreneurs that know how to run a business really well. But when it comes time to doing anything transaction related, oftentimes these businesses just generally didn't have the capacity or the bandwidth internally to manage through the day-to-day of a process. It's really a full-time job. When you think about either doing an acquisition or even going through a sale, it's really a full-time job for somebody at the company to manage the day-to-day execution of that process. And oftentimes you saw that there was nobody kind of picking up that work. It oftentimes falls on the plate of the CFO or even partially the CEO or some other roles. And generally those folks have day jobs and they're busy day-to-day, and managing the full-time role of a transaction process is a very significant strain on a business. So I made the decision to start a firm to kind of address that point. And ultimately, we don't provide any investment banking services. It's always a question we get asked, but our role is really to act as a deal team for a company going through a transaction process. We help them with everything from recruiting the right advisors. In a sell-side deal, we'll help you pick the right investment banker, and we'll kind of act as your deal team to help manage through the process. And the same thing on an acquisition context. If you're a business or an independent sponsor or even a private equity portfolio company that wants to do an acquisition but needs a deal team to manage the entire underwriting process, work with all the third-party advisors, and just kind of help you through the diligence, we'll step in to do that. And we kind of give institutional grade M&A execution to middle market businesses and lower middle market businesses that generally have never had an M&A resource internally.
Jeremy, thank you so much. And we will actually focus a lot of time with you in one of the questions here, the mistakes that founders sometimes make when preparing for a transaction. Sometimes they're not mindful of all these services or things that are needed to get from point A to point B. Tom Malin, Harvard Business School, commercial real estate to begin with, founder of one of the nation's largest surgery center companies, now leader of Perpetuate Capital. Take a second, Tom, if you don't mind, and introduce yourself.
Thanks, Scott. I've had the pleasure of working with Scott since the mid 95. I think we met on two different surgery businesses as a counselor and as an advisor and as a marketer and as a board member. So I really appreciate the opportunity to be here with you and help and be on this panel. I spent from 2001 to 2016 founding and operating, putting together the team to manage ambulatory surgery centers with Regent Surgical Health. That company had grown dramatically. It had been very profitable for the founders, of which we had 12 of us who put the money in. We had no institutional capital. We got to 2016 and realized that we needed to do a transaction. I had two partners who were over 70 and a partner who had passed away that owned 40% of the business. And so we looked at private equity, we looked at strategics, but the management team and I dug into what does an ESOP look like for a company like us. And we ended up after about 9 months, we're transitioning the company to an employee stock ownership plan. And what that is a company is basically creating a trust for the benefit of the employees that does a leverage buyout of the business. And Scott was with us in the board discussions on that. And the company then operated for 4.5 years as an ESOP, and we paid down substantial debt. The sellers were able to shield their gains with by converting the proceeds into stocks and bonds of U.S. companies. We sheltered, didn't have to pay capital gains tax. And then the company became a qualified pension plan and didn't have to pay federal income tax. So it enabled us to accelerate the pay down of debt. And then we had an unsolicited offer to buy the company during COVID, which looked at the management team and they all wanted to do it, and we did. And we had a very successful sale in 2021 with 13 of our employees becoming millionaires. And even the ladies who did billing and collection, who had been with us for the entire time as an ESOP, got $400,000 to $600,000 in their IRA accounts. It was truly life-changing. After that, I decided that I wanted to help other business owners do a similar thing. And we identified the missing link as the middle piece of capital between the seller financing and the bank financing as being the missing piece. It was not a good option for us to work with Mezz Capital. So we needed a lower cost, more flexible capital structure, and that's how we created Perpetuate Capital, and that's what we do today.
It's fantastic. Bart, I'm going to ask you the first substantive question. Bart Walker, by background, is a partner at McGuire Woods, helps to head up the healthcare practice, which is one of the largest in the country, does a lot of work at the mix of private equity and deals. I'm going to ask each of the three of you a different question. Then I'll ask each of you, Jeremy, Tom, Bart, to feel free to comment on one of the other questions if you wanted to jump on that. Bart, I'll start with you. When you look at today, business services, healthcare, where are you seeing the most interest right now? And let's start with in healthcare, because you spend so much time there. Where are you seeing a lot of excitement versus excitement starting to slow down?
Yeah, thanks, Scott. And before I start, I'll just say hello to Tom. He was one of the first clients I think I ever had the privilege of working with when I started at McGuire Woods. So have been following his career, and I've learned a heck of a lot from him over the years, just watching him and the growth of his companies and his success over the years. Some of the areas that I see today are not strictly physician services. I think there was a bit of not a moving away, but a bit of a chilling on physician practice management, where the old recipe of just kind of buy a big physician practice and then strap on a bunch of add-ons to it and dollar cost average down the value of the platform and then exit to a bigger PE fund. That formula, it doesn't work unless you actually kind of know what you're doing. And I think there were a lot of people that got into that maybe didn't necessarily have the depth that they needed to make that kind of a business work. But what we're seeing is things like infusion, ASCs are still very, very popular, profitable, specialty pharmacy, mobile imaging. And then beyond healthcare services, we're seeing people get more interested in things like pharma services. So it's the whole constellation of companies that provide services to big pharma, whether it's domestic manufacturing, supply chain, cold storage, sterile manufacturing and storage, fill finish. That whole set of companies is attracting an awful lot of interest. and then not necessarily a niche or a specific industry or sub-industry, but we are starting to see a lot more PE funds partnering with health systems in unique and interesting ways, and that could be across different treatment modalities, different types of providers, also providing strategic business support to the health systems. And so you're seeing a lot of this matchmaking happen behind the scenes where you've got a PE sponsor as well as a health system and kind of bringing the expertise of those two organizations together. We've been seeing an awful lot of that lately too.
Thank you very, very much. There's so much interest in the pharma sector, the pharma AI sector, the development sector, plus pharma services and distribution still too. Thank you. And probably less interest, at least some of the physician practice areas. The orthopedic stays very hot. Some of them remain quite hot, even though there's some less of interest in some other areas. Jeremy, let me ask you the question of mistakes that founders make in preparing for a transaction. That seems right up your wheelhouse, and you end up solving a lot of those problems. Talk to us a little bit about some of the mistakes that you see founders make in preparing for a transaction and looking at the market.
Yeah, sure, happy to. So that's definitely something that comes up a lot. We tend to get involved with clients who want to sell a bit earlier on in the process. So our role, kind of like I mentioned, is really to get them prepped for the process, make them institutional process ready, and then ultimately help them recruit the right investment banker and then manage the diligence process. But a lot of the things that we'll see kind of early on, which is a big part of what we do to try to help them. Oftentimes, business owners, like I said, run a fantastic business, but a lot of the business lives in their head, right? They don't have documented processes written down. They don't have necessarily their customer contracts properly recorded. Maybe some of their vendor agreements are kind of handshake deals. These things, when you're running a business, sometimes, that ends up being fine. But when you're getting into a transaction process, any sophisticated or institutional buyer is going to uncover that, and that's going to be more often than not, a large discount to value will happen as a result. And so we try to get ahead of a lot of that and make sure that everything is kind of formalized, contracts are in place as need be, and the business is really kind of institutionalized from a process perspective. Some of the other things that I'll see, and I'll talk a little about, more about on the advisor side, besides just actually prepping your business, one of the biggest mistakes that I see sellers making is trying to go into a process without having done a sell-side QV. I think doing a sell-side QV is one of the most important things that you can do as a seller as you're getting ready to go into a process, because it really gives you visibility into what is your EBITDA and what are the adjustments that make up your EBITDA. Oftentimes, sellers and successful entrepreneurs don't know how much cash they're taking out of their business at the end of the year, but to have a real understanding of what makes your business, what is your actual adjusted EBITDA when you think about, cash to accrual, cash to accrual conversions, family add backs, pro forma adjustments. All these things have really, really material impacts on value, and having very strong visibility into what those drivers are and what your EBITDA looks like from day one, it just puts you at a much better starting point, because you've done the work to actually establish, here is what we think our EBITDA is. Of course, buyers will come in and do their own QV to assess, how what validity do we think your numbers have? But starting with an accounting firm, a reputable QV firm that's actually done the work, has put the stamp on your numbers, very, very important when you're getting started with any process. And then I'd say, as a broader point, having the wrong advisors is something that I see a lot of business owners also struggle with. So sometimes, business owners will bring in a lawyer that maybe doesn't, when they're getting ready to go to market, they'll bring in a lawyer that doesn't specialize in M&A, or they'll bring in an investment banker that doesn't really have expertise in their industry. These are also areas where a lot of decisions have to get made early on in the process, and these are areas that also could end up really hurting you down the line. You spend a lot of time with maybe an advisor that doesn't know your space so well, doesn't know the buyers. That can mean you left some money on the table. If you have a lawyer or another set of advisors that don't really, are not really M&A, people or M&A advisors, could also just make things more complicated. So those are always things I like to tell my seller clients is, make sure your business is prepped and obviously have the right set of advisors, because that's how you, extract the most value at the end of the day.
Thank you very, very much. And Tom, you've been through this process a number of times, both as now an ESOP investor, but also with years as an investor, but also as a founder, as an operator. If you're advising a CEO today that's considering a sale, he or she, in the next few years, what would you tell them? What do you tell a CEO to focus on in getting their business to be ready to be investable?
As Jeremy said, advisors are critical. In the ESOP world, there's a larger number of advisors than the non-ESOP world, because you've got a trustee with his financial advisor. The company has a financial advisor. There's lawyers on both sides. The costs are exactly the same, or maybe even less if it's done properly. But as the seller, you're doing this one time, and you sit there and you feel like you're at a poker table and you don't know who the mark is, and you feel like the mark because everybody around the table has done it many, many times, and it's your first time. It's a very disconcerting feeling. The other thing I would say to a seller is, once you get the right advisors around the table that you trust and are doing, representing you as much as they can possibly represent you, do not take your eye off the ball of your business. One of the things that I think Jeremy can bring to the table to a lot of sellers is they don't.
Deeper conversation too,
Michael, if we can get your Michael Muto, if we can
trying.
get you muted, thank you so much.
If the company is not hitting its numbers because everybody is focused on the sale, they're thinking about what sports car they're going to buy, they're thinking about the second home they're going to buy, and they're not focused on the business. There is nothing that will kill a successful sale quicker than the company falling out of bed during the transaction process.
Thank you. And Tom, you've done this great job of having clarity about what you think is the right direction. How do you balance that with advice from advisors? Because you're one that's, very smart, very clear sometimes about here's the goals. And you'll have advisors that are all over the board in terms of what they see out there. How do you balance your perspective as a founder CEO versus that of your advisors? When do you listen? When do you say thank you? And how do you attack your own course with all the different opinions out there?
Well, the most important thing is to align interests. Okay, we hired. I had a bad advisor starting our sales process. It was me. I was marketing our company to the industry that seemed to be the most logical buyers of our company. That was a failed effort. Then the next year, we hired a great investment banker who knew our industry very well, and we aligned interests. He was going to get paid a nice payday no matter what we did. If we went to a private equity, if we went to a strategic, or if we did an ESOP. I actually paid him his fee on money I was lending to the company as a seller financing. And you have to have mutual interests. Otherwise, an investment banker will just try to push you into the highest price, quickest deal that they can do so they can get off to the next client. And that is a bad position to be in.
Let me ask you both this question. Bart, I'll start with you. 30 seconds each. And how do you evaluate investment bankers? When you have a client looking at hiring an investment banker, and then Jeremy, I'm asking you the same question because this is right in your wheelhouse. And then Tom, and we've seen this process multiple different times. It's just in a process where the company literally interviewed 10 different investment bankers, which I felt was overload. But Bart, how do you look at that because the investment banker is such a critical component? And to Tom's point, whenever I, as a founder, have done this myself without a banker, it's been a big mistake. But
yeah, it's a good question, and I agree. You don't interview 10. I think you probably pick 2 or 3 of the right ones, and before you even make that phone call, you get recommendations from your lawyers, your accountants, your other business advisors, folks in the industry, people on your board. I couldn't agree more with what Tom said. You really need somebody that knows your market and knows your sector, because that's really a big part of the value that they're bringing. It's not just a generic M&A deal. It's specific to this industry. There are specific buyers that are interested in only certain assets with certain characteristics. And the quicker you can get to the right advisor, the quicker you can get to market and ensure a smooth process. That's my big advice is get as much feedback as humanly possible. Ask for references. I'm always surprised how many people actually don't even talk to references. Like, who have you worked with? Who are the founders you represented? And then give me the names of 2 that haven't worked out or deals you haven't closed. And if they can't give you those, then that may give you your answer.
Love that. Jeremy, this is right in your wheelhouse. How do you advise people about interviewing investment bankers, think about who they should work with, accountants, investment bankers, et cetera?
Yeah, sure. I would echo a lot of what Bart just said. I think it's maybe making sure that you're talking to people that really know your industry really well, especially in the lower middle market. A lot of different bankers or brokers could look the same, but really having somebody who really knows your industry very well, knows the buyers that are interested in your type of business, and knows really, frankly, what are the structures that are market today, and what's the best and most likely outcome for your business. So I think everything that Bart said is a lot of the things that we look at. What's your expertise? How many deals have you done? What's your buyer network look like? One of the things that we'll also spend time is just, frankly, is there a cultural fit between our client and the banker? At the end of the day, the banker is going to be a trusted advisor for it could be a 6 to 8 month process, and making sure that there's a cultural fit and an alignment between the client, the seller, and the banker also very important. You're going to be working together hand in hand. You're going to be presenting the business. We're going to be talking to buyers, making sure that everybody's on the same page. And what part of how we look for that is every time whenever I introduce my clients to bankers, it's always every banker is going to be able to tell you this is our experience in the space. These are the deals that we've done, and a lot of that is obviously, like Bart had said, super relevant. But we look for kind of this smaller, more, some of the undertones where do they understand some of the nuances of the business that are really important to the client, right? It's easy to just say, hey, you're in this industry, buyers like this aspect, and they like this type of customer base, and they like this type of end market, exposure. But hearing from a banker that they really understand the client's business in a very intimate and nuanced way, the way that, which kind of expresses how the client really feels about their business, 9 times out of 10, ends up creating a really strong cultural fit and alignment between them, which makes for, a good partnership throughout the process.
Tom, let me ask you this question as a follow-up. When you look at it, investing now through Perpetuate Capital, what drives you away? Give me a sense, a quick sense of what leads you to look at a deal and say, we're not doing that deal. Bad numbers, bad CEO, bad leadership, market challenges. What leads you to say, not for us?
Well, as a fund where we might be investing in a company, we're doing a leverage buyout. So the company has to have some stable cash flow. It's got to have some long-term contracts. It's got to have the typical things you look for in a private equity deal, good management team, that type of thing. The thing that scares us more than anything, and me personally more than anything, is someone who doesn't know what they don't know. There's a family involved. There's family dynamics that are bad. We walked away from a really good company in the Bay Area that in an industry we really liked, that had all the characteristics that we wanted, but the dad and the 2 sons couldn't get along and couldn't agree, and we finally just stopped, left.
Let me ask you a question on that. If you were ever working with a founder who had 8 children or more, would you find that to be an impossible situation?
No, absolutely not. Unless all 8 children worked in the business and they hated each other, and the parents pit them off against each other their entire lives, and they can't get along. That's a
right.
question, Scott.
I mean, the question is, Bart is in that situation with, I think, 8 children currently, but they're not all in the family business nor pitted against each other, are they?
Not yet. Most days, not.
Okay, so they'd still be a candidate. Good, but okay. So
I had 3 children. And none of them wanted to be in the surgery business that I started. Today, one of them works for Medtronic, and the other works for Denver Children's Hospital. So, 2 of the 3 are in healthcare anyway. So
the apple didn't fall that far from the tree. Is fantastic. Jeremy, best thing you've seen a founder do or CEO do in bringing a company to market. Give us an example of someone who's really hit this right and done it how it should be done. And you don't have to give a name, but someone that you've worked with, you say, like, they really had it. They really knew what they were doing.
Sure. I think of somebody they're working right now, just really strong command of their numbers, and their data, right? So if we're talking to bankers or even prospective buyers once we're in the diligence process, and they're saying, yeah, we have our end market exposure is X, or our customer base is, our customer channels are Y, there's data immediately to back it up. So it's never just like, this is our feeling, this is our thought. Ultimately, I think what buyers really want to see, especially in today's environment, is the ability to underwrite, the ability to credibly underwrite their base case and their assumptions with the data to back it up. So it's very easy for a seller to say, hey, I know in my head that this is what the business has been doing over the past number of years, but being able to show that in data translates to a very, very smooth underwriting process for a buyer who's then able to really understand the business from a much better perspective on a much more deep level and be able to underwrite and ultimately ideally ascribe a higher value to. So I think having a really strong command of your data and your financials super important. I think also some of the best sellers that I've seen are the ones who know what do the buyers actually care about, right? When you think about like what levers actually create value in your business from a buyer, especially an institutional buyer perspective, I've seen business owners that spend a lot of time on certain initiatives that maybe are helpful, for a short time period or at some low hanging level, but ultimately having an understanding of how institutional and particularly private equity buyers operate and what they're interested in, having an understanding of that and kind of operating your business in that way in advance in the few years in advance of a sale is a really easy way to increase value because you can spend that time on the high value levers that really will give a buyer a lot of conviction and ultimately again give you the highest value.
But I love that point about sellers, founders, CEOs that really know their business well, inside and out, know what the real issues are. I also love your point you said earlier. So many founders, mid-sized companies live with so much of what their systems are in their head versus on paper and really put to a way that can become systematic and institutional. And I love that point you made there as well. Bart, when you see sellers, founders, CEOs doing a great job working through a process, I've seen you do it side by side with you a ton of times with great bankers, with some people that you work with regularly. And I know you've developed these great long-term relationships with people because you show up every day in a really professional way. But talk for a moment about what you see companies doing well when they're getting from point A to point B in a process, and then we'll wrap up this section.
Yeah, number one is what Tom said earlier. You can't take your eye off the ball. That is absolutely number one and number two on the list. I think a close third is know thyself. Do a little bit of introspection, do a little bit of self-diligence in preparation for the process. If there are skeletons in the closet, you want to know about it before the buyer does. The worst thing that can happen is you're going through diligence and the buyer comes up with something, whether it's a legal or financial or tax problem, that can derail a deal, if not cost you real dollars in the form of an escrow or a specific indemnity related to whatever the problem is. So a little bit of money and time spent up front, being very intentional around what are our weaknesses, what are our problems, if any, and doing a little bit of cleanup on the front end can really smooth the process.
Thank you. I want to thank all three of you. It's a pleasure to visit with each of you. It makes my day. It's really a pleasure. I'll also take a second between sections. We're going to start in a moment our artificial intelligence for business leaders session. We've got four fantastic panelists for that. Andrea Marin, Robert DeVita, Will Conaway, and Brian Taylor. Before I do that, let me take a moment to again thank our gold sponsors, Grange Park Partners and Jeremy Jacobowitz. Thank you so much. Elevate Talent Advisors, Dylan Werner, Tom Malin, Perpetuate Capital, ModMed, Jeff Friedman. Thank you to ModMed. Brian Taylor, who will be joining us next from ThinkSpan, brilliant founder and serial entrepreneur. Chris Lacey, Priority Search Management. McGuire Woods, Bart Walker and team. Paula Avenheim and Baird and Warner. And I think we fit everybody there. Chris Lacey, Priority Search Management. I think we mentioned that as well. But I want to thank all of you. You make this possible. So thank you very, very much for sponsoring and joining us. A fantastic group. We'll go through a handful of questions. We're going to focus a lot on what's working in artificial intelligence use cases, where people are actually moving the needle and not. Brian, I'll ask you to start by introducing yourself. Brian, can you take a moment and just introduce yourself and tell us a bit about your background as an entrepreneur, which is fascinating.
Yeah, sure. Thank you for having me, Scott. It's great to be connecting again. My name is Brian Taylor. I started in the food business and started a popcorn seasoning brand called Colonel Seasons, and decided to exit that business and had a hankering for a business that pertained to personal information management, that there's a better way for people to store information. And it sounds pretty basic, but it turned out to be a pretty deep tech problem, but landed us square in the middle of AI. We believe we've built the optimal memory system for private AI. And we are in a beta right now, and we are really excited about what we're seeing in terms of traction and the types of things that we'll be able to build with our infrastructure moving forward.
Remarkable. And Brian has just a fantastic reputation, well regarded, and referred to us by colleagues that just speak the world of Brian. Andrea, tell us a little bit about yourself and what you do, and thank you so much for joining us.
Yeah, absolutely. Thanks for having me, and good afternoon, everyone. I'm Andrea Marin. I'm the CFO of Logicalis in North America. Logicalis is a global IT solutions provider. So what we do a lot of things, but we help organizations modernize their IT infrastructure, help them manage and secure their environments, and probably most relevantly to you today is to accelerate digital transformation. And a big piece of that is within AI. It's AI readiness, and it's also, we have a sister company who can assist with the development as well. So in the US, we mostly play in the middle market. And while we are industry agnostic, we do have a strong presence in healthcare and SLED. So my role, I obviously as CFO, I lead our finance organization, but I also am responsible for our IT team, rolls up to me. And then for the past 2 years, I've served as the executive sponsor to our cross-functional AI committee. So with this, I've really been deeply involved in how we operationalize AI across the whole business, including automation, including governance at the enterprise level.
Thank you very, very much. And in a moment, I'll ask each of you the following question. What's the one AI use case delivering results, and where are companies overestimating the use of AI? I'll ask all four of you that question, that combined question. Robert, let me ask you to take a moment to introduce yourself, and thank you so much for joining us.
Rob David, I'm the CEO and founder of Magetics. We're an IT consulting and advisory firm. We deal with mid-market enterprise customers with helping them procure the right technology from an infrastructure perspective.
Thank you so much. And talk just for a moment about the founding of the company, Rob, and tell us a bit about that.
Yeah, sure. Started my career off at AT&T. I've got the bruises to prove that. Then spent 15 years in the data center space. Was really looking at how can I help more of my contacts and my customers, really holistically provide better IT infrastructure to their environment outside of network and just outside of data center. So was able to form the firm about 9 years ago next week, where we are a holistic IT consulting practice helping enterprises to procure IT infrastructure in a more educated manner. Over the last 18 months, our largest growth engine by far has been AI enablement and just teaching really C-levels how do they use AI efficiently, and then how do they cascade that into their organization.
Thank you very, very much. Will, you've had this fascinating, varied career. You also teach. You've got a consulting company. You're a healthcare guru. Talk a little bit about yourself. Tell us about yourself.
Sure. Will Conaway. Thanks for having me here today, Scott. I appreciate that. President and CIO of Tuxedo Cat Consultant. Tuxedo Cat Consultant is a technology and advisory firm specializing in artificial intelligence, run strategy and digital transformation. In my career, I've held executive roles in multi-billion-dollar organizations, including president, chief operating officer, chief growth officer, chief of staff at a large healthcare organization, vice president, consulting provider leader, and chief information officer. I'm a member of the World Economic Forum, the senior executive AI think tank, and the Forbes Technology Council. Last year, I co-authored a best-selling book, The AI Universe. Also, the global recipient this year in 2026 of the Constellation Research AI 150. In the past, I've also was the Icon Award winner for digital health, and the Constellation BT 150 award winner in technology, and a former Becker CIO to know. I've worked with master level students at Cornell University now for 15 years. Just starting a new course right now. Going to do an interesting thing, teaching with General George Casey, 36th Chief of Staff of the U.S. Army. So pretty cool opportunity there. And I continue to serve on boards and advisory committees where I focus on technology, organizational strategies, and economics.
Let me start with this question for all four of you. And Brian, I'll start with you. the one AI case, and everybody's from a different perspective, but the one AI case that you see people leaning into the most right now in business, and you're working on your own company, but what do you see outside of that? Sort of when you think about the one AI use case that people are really leaning into, where do you see that? Any thoughts there, Brian? And then Andrea, Rob, and we'll ask you the same question.
Yeah, I think there's a real opportunity for, coming from the entrepreneurial perspective, from someone running a small business who has both the domain context and the authority to make decisions. You have a McKinsey strategist, you have an expert marketer, a researcher in your pocket with AI. And the whole key is knowing what are the right questions to ask. So there is so much information available, so many ideas, assuming that somebody knows the right question to ask. What is it that you want? Sometimes it sounds so simple, but the use case is simply asking a question in helping your business, right? It could be if it's a dental office, just to pick kind of a random example, and you're trying to grow the business. If you simply describe your business, I'm looking to reduce my expenses, I'm looking for ways to increase my revenue, and you'll be shocked at the richness of the information that's provided. So there is it's asking questions, but I would say for business, for an entrepreneur, asking the right questions and really thinking about what is the thing that you actually want to know, what's going to move the needle, which isn't always as simple as it seems. But if you work with AI, it can really prompt some unique insights and deliver tens, if not hundreds of thousands of dollars of consulting value, very quickly.
I mean, it's amazing how quickly and in an expedited way it could accelerate your processes and how you think about things, isn't it? I mean, it's literally remarkable. And it's both of us on an individual level, small business and large enterprise level, where we're starting to see that. Andrea, take a second on, the one AI use case, or pick one that you see delivering the most measurable return on investment so far today. And then Robin will ask you the same question.
Absolutely, Scott. And I will actually start off by saying, Brian, I couldn't agree with everything that you said more. I think it's so important to look at your business in the way that you described it. But within Logicalis, I would say that one of the most tangible AI returns that we're seeing is within contract management. Our legal team deployed a third-party solution called Luminance to really automate the whole workflow related to contract review, contract management, automate a lot of the negotiation process, actually. And the reason that we picked the legal team first was because we, in our 3-year plan, expected a large growth in volume from our customers, which ultimately carries back directly to our legal team, right? More customers, more deals mean more contracts to review. And it was that department that would be the most strapped for capacity with our revenue growth. So by implementing this contract management platform, it really enabled us to grow the business without adding any additional pricey legal staff, which as a CFO is important to me because it really helped our margin profile when we scale with our growth. So it's been able to accelerate the revenue cycle so we can close deals faster. There's a lot of cost efficiencies that we get. And then also in general, risk is mitigated. We do still have reviewers in place, but the team is able to manage the workload much better.
How hard was it to implement a contract management system that was AI enabled? How hard was that? What was the lift to do so? And how quickly did you start to see results from it where it got easier to manage your contract stack?
That's a great question. It was harder than the team that sold it to us would have suggested. And we were expecting a 2-month implementation based on all of the discussions that we had leading up to the implementation process. At the end of the day, it actually took us 6 months or maybe even 7 months to fully implement it. And the reason for that was because we needed it to learn from us and from our legal team more than we expected it to. And so the additional time that we took through implementation was really teaching the system on how to behave, teaching the system the provisions, the clauses, the negotiation points that were really important to us before we felt comfortable letting it go more on its own with only a certain set of review and audit along the way.
How frustrating was the difference between the 2 months and the 6 months? Or were you able to see enough of the potential there during even that first 2 to 3 months to say, okay, this is going to be a longer slog than we expected. It's going to be more input from us than we expected, but we could see the benefit of it. So we're not ready to throw the baby out with the bathwater. We could sort of see it. How tell us a little bit about that journey and the frustration versus, okay, we can see enough promise that we'll stick with this and really move forward.
The people on the ground that were managing the implementation started to get a little bit of fatigue when they were working through it. And honestly, they wanted to give up at one point. But at a management oversight level, we definitely still saw the value. And we weren't about to enter into, we didn't sign the contract just to give up a couple months later. And so in speaking with the third party consultants that we were working with on the implementation, they were really able to get our team back aligned and to stay on track. And ultimately, I'm glad that we did, because it is operating just like it was sold to us.
Thank you. No, I think it's always a great question and always a challenge in implementation of what the team sells to you versus the actual lift to get it really going. And thank you. Rob, any thoughts on AI use cases and where you're seeing the best results currently for customers that you work with?
Yeah, for our customers, we're seeing it, both good results and very bad results on the agentic agent side. We're seeing good results where they are not trying to replace humans holistically. A really good use case is we've got a dental practice that we work with that has about 250 dental practices in the US, and they're going to use an agentic agent for after hours, right? So they can still take appointments. It's a complement to their 9 to 5 staff. Not there yet to replace an entire human for anything that someone would need to call a dentist about. But if you're calling after hours, you want an appointment in the morning, and you're able to book those at 11 o'clock at night, instead of waiting for a call back in the morning where they may have already called 7 other dentists and got in the morning. Where we're using it internally is for a lot of sales training. We've built a sales coach that will do pitch practice. It'll take your pitch, it will then grade it against our ICP and the message we want to deliver as an organization. We've also done call recording. So all of our customer calls are recorded via Zoom. And then we've got an agent that goes in at 5 o'clock every day and scores every one of those calls for us. As an executive, I can look at a dashboard now instead of having to sit on these calls and do coaching, or my CRO doesn't have to sit on every call and do coaching. And then readiness for sales calls, right? There's no excuse for a salesperson to show up to a meeting now and not have intrinsic knowledge about what this customer does. So we built an agent where you can go in and type in any customer name, and it will give you, a 90-day view of all their news that's out there. It'll give you, based upon what we do, what products and services in their vertical they are most likely to buy. And it also gives you things that you shouldn't say to them. So what to stay away from. So there's different ways to look at this.
One follow-up question, and I take it in your business, at least maybe originally you were the rainmaker, or maybe you and some others were. There's a great article last week in the Wall Street Journal about how the rainmaking skill in these big investment banks is the one thing they're having a hard time replacing with artificial intelligence. Any thoughts on that? Can you give us 2 seconds on that question?
Yeah, I mean, you can essentially train an agent based upon your thoughts and your actions now. So if I say I had an intrinsic value or way that I do things, right? If I want my team to do it a certain way, those are the instructions that I give it. And we like to do it off of real life scenarios like we talked about with the Zoom recordings. So what steps would I go through? So there's work on my side or our CRO side on the first couple that we reviewed to say, hey, how would we have handled this? And let's build that into the agent that these people are using that they're training off of.
Thank you. Fascinating. Will, AI use cases are delivering ROI today. What do you see working so far?
And going last, you always have to take a little different perspective here. So I'm going to. I think one nuance that we need to think about here is that ROI might not be enough. Of course, leaders need financial returns. We all know that. But AI is also expected to produce outcomes too. Faster decision making, better customer and patient experience, stronger risk reduction, improved compliance, especially when we start talking cyber, more resilient operations, better employee capacity, faster innovation. Of course, we all have to figure out ways when we're working with our clients how to teach them to compete in an ever-changing markets. So the question is not only did this AI project pay for itself, I would say it's also did it make the business faster, smarter, safer, and scalable, and more defensible. Looking at things, one of the things I am seeing that is just doing great, especially in the health, life science, and payer, are contact centers. AI can answer routine questions, open 24/7, summarize customer history. It can retrieve policy, guide agents, and escalate exceptions. So there's a lot of measurable value through there because you can actually have metrics that you already know around cost per contact, handle cost, first contact resolution, deflection, and such. So AI becomes operating leverage when it's embedded into the workflow, just not added as a tool. So working a lot into provider healthcare, I'd also note that clinical AI is the headline everywhere. However, financials and operational AI is where most hospitals right now can show the fastest ROI, and that is the strongest near-term ROI is around administrative automation, not replacing clinical judgment, healthcare revenue cycle, where healthcare areas include scheduling, benefit verification, prior auth, clinical documentation, coding, denials. Those are the things I'm really seeing. The one caution I do have for the healthcare system is privacy and your privacy, safety, compliance. Those are all things that are kind of designed in from the start, so you can have some issues. I believe the second part of your question was where companies are overestimating AI in the near-term impact, and I would say companies overestimate AI when they confuse tool access with transformation. And I'm seeing a lot of that with clients. Also, giving employees Copilot, that's not the same as redesigning your workflow. And time saved, I'm witnessing quite a bit. Time saved with automation and such does not automatically become P&L impact always. So productivity only becomes value if the leader can convert it into capacity, speed, lower cost, better service, risk reduction, and revenue growth. So for the provider healthcare, getting your board prepared for what they're most not capable of doing right now with oversight and governance is something that I'm seeing systems are very much struggling with. And I would also say that in healthcare leaders should be especially careful not to overestimate near-term clinical autonomy, the danger of deploying AI faster than the organization can validate safety, bias, privacy, clinical accountability, and of course, reimbursement implications.
Thank you, Will, so much. And I couldn't agree with you more in healthcare, more on the administrative side than clinical side so far. Andrea, let me ask you this question. It's one of the questions from the audience. The question essentially says, the Anthropic CEO says that a good percentage of entry-level jobs may be replaced over the next 5 years or so. That, we even see this already in investment banks, private equity, where this movement, slow then quick, towards more of the early analysis, preparing books, doing other kind of things being done by AI. And, one investment bank told us you're going to need a third less entry-level analyst because more of it's going to be done by AI and so forth. The question that's raised is corporate training, corporate ladder. How do you still prepare that next generation for jobs at more senior levels when they're doing the basics, the starting points, the fundamentals in a different way? Any thoughts on that? And then, Brian, I'm going to ask you about how CEOs should prioritize AI investments with limited budgets. And then, Robert, I'll ask you about AI change, what we're going to see most dramatically change the next few years. But Andrea, talk to us about how will this change corporate training and the corporate ladder as some of these junior positions are done more and more entry-level by AI types of tools?
Yeah, I absolutely think that it will impact training. But the challenge that I see companies face today is that they're trying to move too quickly. They're automating before they have a plan in place to handle the change management, to handle the data governance, to handle the training, and what does the role progression look like in the new normal after the entry level positions are automated. And so companies really, really, really need to focus in on what does that career path look like. And it's different for every company, it's different for every organization, right? Depending on what the role is. But I think that a lot of the positions that we have entry level people in today, once those roles get automated, it's really going to be a different skill set that's needed to get to that next level of the reviewer, of the person who's helping manage the workflow automation. And there's a very good chance that the person that's in the entry level role today won't have the right skill set or brain to handle those other jobs. So that's something to be quite aware of. But you really need to identify what that next level of the role is. What are those responsibilities, and what are the skills and capabilities that are required? You need to put a lot of thought into that, and from there, design the training that's required around it. You may have the right people in the roles that can move and switch gears and take those positions once their entry level becomes eliminated, but you very well might not be prepared, and you need to be ready for that.
Thank you. Couldn't agree more. I mean, you have advanced teachers saying that some of their students are less rigorous because they're doing so much through AI. So how do you develop that right rigor when people aren't going to be doing some of those early level tasks that used to help them develop that rigor? And so training and how you're going to get from point A to point B becomes that much more important. Brian, let me ask you the question. You're a CEO, you're a founder. How do you think about prioritizing AI investments today when you obviously can't be unlimited in your spending? How do you think about prioritizing?
Yeah, I think that's a great question, and there's a couple responses. I think one is you treat it like a regular capital investment and you evaluate the potential return. But I think the interesting thing about AI is that there's a return for just trying, even if it doesn't work. By exploring AI for your business, or for a certain use case, it forces you to think about your information and think about how the business information can be structured better. It forces you to think about the processes, and these are core skills that any good business person, even pre AI, should be thinking about. So now we're taking a fresh look at data. We're taking a fresh look at processes, and if for some reason the AI isn't the right fit, if it's not working and delivering a return, there's going to be a benefit from that fresh look. Also, one of the things that we're actually baking into our evaluation of AI is that in some cases, the AI isn't quite doing the job right now, but it's changing so fast that in 3 or 6 months, we're going to take a fresh look. We're putting a pin in certain projects saying, all right, we're not going to bang our heads against the wall right now, but things are moving so quickly that we think that it might get unblocked later. So I think it's important to get started and try. You're going to learn, and it's going to benefit the business by teeing up the infrastructure for AI. And even if it's not the right fit at the moment, you're getting closer to the point where you will see a really exciting return.
I love that perspective, and also that view of this as a work in process. Rob, let me ask you this question. You work with a lot of different companies on implementing technology solutions. How much do companies want to be the first mover versus companies like, at least we've traditionally been, where we don't want to be the first mover. We want somebody else to have used something well and then use it ourselves. What do you think about there? And then where will AI most dramatically change in the next few years?
Yeah, first, I think we've seen the quickest adoption in the AI space from medium-sized enterprises. So they've been the quickest to adopt. They've got a concentration and a spend level, but also don't have a lot of the red tape or technical debt that some of the large enterprises are going to have. What we see folks moving to, really, when we look at this from any AI application or any AI decision you're going to make, the key is having the C-levels in the room educated on AI, right? They need to know at a very basic, you'd be surprised. We walk into these rooms and they're using like Google. They have no idea how to prompt. Once we're done with the education on what they can use AI for, the light bulbs go off in the room, and they're now creating 7 to 15 different things that they want to AI enable in each one of their lines of business that they control from a C-level perspective. So I think education at the highest level has to be the first thing. If you are a C-level and you're approving AI budgets for anyone in your org, and you don't know what it is you're approving, then there's a good chance you're going to have a failure inside of here, because not only can you approve the project, but you've got to be able to, command and demand that the rest of the organization is going to use these tools. And that's where we see a big disconnect with a lot of the failed AI projects that we walk into customers and they said, how do we not repeat our steps that we just wasted tens of thousands or hundreds of thousands of dollars
on? Thank you very, very much. We've got a couple different questions. I'm going to try and direct each of these to, we've only got a few minutes left here. We got a couple different AI questions. And I'll ask, is there a proven blueprint that organizations can follow to design and deploy AI governance at scale? Will, can you give us 30 seconds on this? Because I know you spent a lot of time on this question. Any thought on blueprints that could be used, but ideally a relatively short answer to give people a sense of where to go on this issue?
Yeah, really, it's still forming pretty much, especially when we're talking in healthcare. I see a lot of problems. Boards are being asked to approve AI strategies, govern AI programs, and attest to AI-related disclosures right now. But boards are now expected to oversee complex AI initiatives, not just approve technology spend, but also how AI aligns to organizations' missions, patient safety, its regulatory obligations. So we really need to, I am finding that what I find to try to do is get the core of cybersecurity involved here. This is where we're really seeing some big hits. So AI systems need to really, with AI, it's really increasing the surface attack, so to say, of what we're seeing AI being able to hit throughout healthcare. So one of the things I like to look at is like the HHS framework. If you're not familiar with that, please look that up. I think that's a really good framework to look at. Also, any type of thing you can find on the NACD, which is the National Association of Corporate Directors. Those are great programs. They're new programs that have come out in the last year here, especially with the NACD. They just put out a new handbook in 2026 that really helps boards that lack the technical and AI specific backgrounds to really understand where the risk and exposure is. So I would really start with NACD.
Thank you so much. Andrea, let me ask you this question. I don't expect specific numbers from anybody, but somebody asked, what's the magnitude of AI spending that's being done? Can you give us a sense of that? And you talked about the 2 6-month project, 2 months turned out to be 7 months. And how much cost is there in staff training and integration and just exhaustion and so forth? But just a sense of, is AI a separate line item today and a budget item, or is it baked into different budgets? How do you think about that as CFO?
At Logicalis, the way that I've approached it is we have a separate line item in our P&L for modernization. A main part of that is AI specifically, but it's not all AI. Data governance and a data overhaul is part of it, for an example. But we've budgeted a certain percentage of our overall annual operating expense spend related to AI and associated tasks like training, like marketing. And it's a little bit less than 5% of our total OpEx budget.
Thank you very, very much. That's a great sense. Rob, any thoughts on that? What do you see people spending allocated to AI, or is it part of a bigger technology budget, or how do people look at that?
Yeah, we're seeing that IT budgets are not expanding. In order to deploy a lot of anything else inside of the organization, and it's not just AI, right? It's got to come from someplace else. We do see budgets freed up when it comes from the business side and not specifically inside of the IT budget. So the IT budget is not going to handle, any optimizations inside of the business unit, right? That's where the business unit owner has that budget. So if you're able to, increase revenue and decrease headcount, either one of those or both of those, that's where you're going to see budget freeing up. It's not going to be from the IT budget. AI is very rarely an IT discussion. It's more of a business discussion.
Right, a business use case discussion, a service line discussion, and so forth. Brian, any comments there on how you budget for AI as you're working through what you're working through, which is really an AI-driven, company in a lot of ways?
Yeah, especially for engineers, software engineers who are relying heavily on AI. There's been some suggestions that you should consider the salary with its kind of commensurate AI budget. And there's even, some executives who think that the more AI tokens that are spent for an engineer, the better. That if an engineer isn't spending X number of tokens, what are they doing? That you're not getting the full capacity of the investment in the high level salary. So so I guess my comment might just be that hey, like it's part of the HR cost. It's part of the salary cost. It's part of the tools that somebody needs to do the job, and maybe that's what accelerates the efficiency of the workforce.
Thank you. I want to thank all four of you. What a pleasure to visit with the four of you. Andrea, Rob, Will Conaway as always, and Brian Taylor as well. Thank all four of you for joining us on this panel on artificial intelligence and use cases. I'll do a quick last shout out to our sponsors here. We'll do another one in a couple panels. But again, a thank you to Elevate Talent Advisors, Priority Search Management, ModMed, ThinkSpan, where we just had Brian Taylor with us, Perpetuate Capital, where we'll talk to Tom Malin again in a few minutes about ESOPs, McGuire Woods, Grange Park Partners, and Jeremy Jacobowitz and Beard Warner. Thank you all for being sponsors today. I want to introduce our panelists or ask them to introduce themselves. We'll have a broad-ranging discussion around real estate and the real estate world today. We've got great panelists. Let me ask Paula, can you start? Because you do so many different things in real estate. Take a moment and introduce yourself. Then I'll ask Ken and Michael Motu from Motu Properties to do so, and then Rick Levin. Paula?
Hey everyone, my name is Paula Avenham, and I live in the North Shore. I live in Highland Park. I have been a realtor in the housing market since 1999. I started off in the mortgage and title industry back then. After college, I worked at the Chicago Mercantile Exchange, went into the fast-paced mortgage business, and then got my real estate license 8 years ago. Best decision I ever made. And I service throughout the North Shore, a lot in Chicago as well. I'm also licensed in Florida, and I'm heavily involved in leadership throughout Illinois, which has been great. A great learning curve just to help me understand the business better in Illinois.
Thank you. Take 1 second, because you live in the residential sector. Ken and Michael live more in the commercial and development sector. Take a second on the residential sector. What does the market look like today? For a little bit, it seemed like not nearly enough inventory, at least in some markets, to sell. What does that look like today? Is that evening out at all? Or what does it look like for a home buyer or home seller today?
Yeah, it's a great question. And it has been pretty much since COVID. It's been really a seller's market on so many different levels. It was just low inventory. People didn't want to show their homes, and for a slew of reasons. And that carried on really until this year, where the market is starting. It's not a buyer's market. It's just not as much of a seller's market as it has been. We're seeing the big shift that I'm seeing is that you're getting 10 offers on the table for every single listing that was coming on the market. True story. And now you're still seeing multiple offers, but before this year, sellers were not negotiating any seller credits. Buyers were offering up to $200,000 above list price. Then they were waiving all of the contingencies per the seller's request when they had multiple offers. The only way you were going to outbid someone else is if you waived having an inspection, waived multiple, pretty much every contingency, even the mortgage contingencies. So I'm seeing that shift right now where sellers are actually starting to offer some seller credits. They're looking more at the bigger picture. Buyers are holding back a little bit. They're, they don't want to get into these bidding wars. They're deciding that they'll stay in their rental home or live with their parents a little longer, whatever their situation is, and wait. They're saying they'll wait a little bit longer. If you see the home you love and you can get in it in a reasonable, without going 200 above and not get into these crazy situations, some buyers are thinking they're waiting because the rates are high. That's a whole nother conversation because really historically the rates are not high. So you just need to talk to a really good, have a good realtor, have a good team, talk to your lender. Because the rates really, it was just very unusual situation. Of course, having the pandemic, right? Probably, hopefully, God forbid, never see that in our lifetime again. But that created this whole ripple effect, because they needed to boost the economy, and we were in a crisis. If we ever see the rates at that low again, that means we have a real bad situation in our hands, and it's just not happening unless again.
No, thank you so much. And you do see some of that market evening out just a little bit,
yes,
where it's been such a seller's market. And one of the challenges with the seller's market, somebody sells their house and then they don't know where to go, quite frankly. You see that challenge in such a seller's market too. Kenny and Michael, tell us a little bit about what you do in the history of Motu Properties.
Hi, Ken Motu. Michael can butt in anytime as well.
I will.
Michael and I started Motu Properties 16 years ago. We own and manage about 100 buildings in the city of Chicago, all north side, all rentals. We don't condo, we don't sell. We very rarely sell what we own. And we do adaptive reuse, and we do existing buildings that we rehab. Every one of our buildings we buy, we gut, and then rent them.
And we do ground up development.
Yeah, and we do, correct.
Although that's relatively new for us.
And what are you seeing in that rental market today? Rents have been going up so much the last several years. Are they still going up like that? And what do you see in the development market? I mean, we see in some of the areas that we live in or see these significant condo or rental buildings going up, not nearly enough, but we see some of them. But what do you see out there in the rental market as well as the investment market?
There's very little supply. I mean, look, you want rental pricing to come down, build more buildings, and it's very difficult. The city of Chicago is not an easy place to build. We're fortunate we understand it, but it's still very difficult for us. And
I think it's also worth noting, like we in Chicago, it's true you don't see a lot of cranes in the sky, and I think sort of the conversations around the Chicago real estate market and our asset class are like you have these other developing states that are in the Sun Belt that overbuild and are stuck with supply, and now they have too much supply and not enough demand. Chicago does not have enough supply, has a high demand.
We're 26,000 units probably undersupplied.
Now I will say they don't report as much about for Kenny and I, if we're doing ground up, which we're doing more of, we're talking like 5-story buildings. So these aren't even mid-rises. They're smaller size buildings between 30 and 50 units, 30 and 60 units. And actually, I mean, we know quite a few developers that are building these type of projects. And, I think clearly the Chicago rental market is probably the best rental market I've ever seen. And Kenny can go through the stats because he likes them a lot, but it's not just, it's tenant retention and then like new product inflation, we'll call it, or increase in rents, and both of those are at the highest level we've ever seen. Our retention's the highest it's ever seen. Our renewal rates are higher than we've ever seen, and our new rentals are at a rental rate that it's the highest we've ever seen, and have gone up year over year.
The last 3 years, Michael, to talk numbers just to give people, if I think it's relevant. I mean, you're looking at people who stay with us. We project maybe 2, maybe 3% increases. We've averaged, we have 68% retention this year, with an average person staying at over 5%. And when we have to renew the lease or get a new tenant, it's over 8%. And those are numbers that we struggle to keep up with. Michael and I used to pride ourselves in saying, "Oh, we know what every unit rents for." I think it's gotten to a point where we're trying to catch up. Our goal also isn't to price our tenants out of the market, but the reality of it is you can't go move. If we raise you 5%, you can't go find a similar apartment for the same rent in the city.
How important is the location of the building, the location of the property, or do they rent well in neighborhoods that aren't as nice too, but just at different rent levels? How important is location still in the rental market?
Well, I would say that, again, our experiences and my brother and I have historically, all of our properties are located in kind of these premier north side locations. So let's just say from Lincoln Square to
West Loop,
to Old Town, to West Loop. We go into Humboldt, Logan. I mean, certainly the demand in those areas has remained very steady, if not increased. And so I don't want to like talk out of turn. I don't know some of the other areas. I suspect that those are also renting. I believe the rental rates are lower. And I think it's important, like Kenny said, what we're finding is that if you're renting with us right now and you wanted to go get a similar place in a different location, maybe an equal location, you're not going to find, you're going to be paying more rent in addition to moving costs. And so we find that people aren't leaving.
I'm going to ask you a question about family pride. One of the brothers is a physician leader. Does that get less or more credibility around the parents and family than being real estate developers and owners of real estate? Where does that fit in, and how does that
Steve
go?
was a pride and joy. Steve was a pride and joy.
Okay, and I don't want to bring down the mood of the whole panel, but both our parents are deceased.
Yeah.
But I will say that I think growing up
was a doctor.
Like, my father was a doctor, so he was always like, we were just,
you were the real estate guys.
Yeah, I mean, like we were.
It's hilarious.
It was very impressive.
Well, as good a guy as they come, your brother as well. So I just was curious as to how that all went, as you guys ended up in real estate and doing tremendously well. And is he ever jealous of your guys' success, or is he okay?
He does very well, and he invests.
I think when he was a surgeon and practicing surgery, he might have been a little bit, but I think he's gotten very involved and excited about hospital administration, which puts me to sleep. So I don't get it, I think, and now he participates in our deals now, so I think he gets a little bit of excitement through that.
A little bit of both. And Rick, you've had this fascinating career. You carved out this incredible niche in the real estate business. Talk about what you do and how you got started in it, and maybe a couple of the interesting things that you've dealt with in real estate.
Sure. Thanks, Scott. And for 38 years, I've been in the real estate and personal property auction business all around the country and a little bit outside the country. And the clients have been wealthy people and people with financial problems and the heirs of people that have passed away, and Bank of America and Chase and the FDIC and the U.S. Army. Obviously, in Chicago, one of the sales that we did years ago that got a lot of publicity was for the U.S. Postal Service. We auctioned the big old former main Chicago post office that the Eisenhower Expressway goes underneath. But all kinds of sellers find auctions beneficial. Sometimes it's because of the urgency, the time, the relative speed in which a sale might happen. Courts love auctions, for example, but so do divorcing couples, candidly, when the reason that the marriage had a problem was because of the house. And it's a good way to get rid of the house and figure out what it's worth. So it's been very valuable, especially when the asset is hard to value.
What are the most interesting auctions you see today? And what does somebody need an auction? I know during 2008, 2009, when there was the real estate crisis or the Great Recession, you were like so incredibly busy. You stayed busy all the way through. Do you do better in bad markets, good markets? I mean, you seem quite busy. What does that look like for you as an auctioneer? When do people come to you to auction off a property?
Well, it's funny you ask. If we were selling Monets and Van Goghs, or if you're the Merck or the Board of Trade or the New York Stock Exchange or the U.S. government refinancing the national debt every week at a treasury auction, auctions are the normal way that many businesses determine value and find value. But in real estate, the irony is that since the Depression in the 1930s, real estate auctions have somewhat gotten a bad reputation. So to that end, in that 2007, 8, 9 period, when real estate values were falling, which hasn't really happened in most of our lifetime, places like Las Vegas, homes were going down 10% a month in sometime in that 2007, 2008 period. So sellers like Fannie Mae and Wells Fargo and GMAC Bank, now called Ally Bank, were calling us and saying, please auction these properties. We were running to Vegas and Detroit, which had a precipitous drop. The urgency there was they had to move the inventory because they were getting so much inventory coming in, they just couldn't handle it. However, these are relatively good times. It is a seller's market, as Paula was pointing out, and it's all about supply and demand. And right now, the supply is low in residential in most markets, which would be an excellent time for sellers to do an auction. But many sellers really can't get their arms around the fact of doing an auction. And because the stock market's at an all-time high, and they feel that their home is maybe going up 1% a month, 12% a year, they don't really feel the urgency. And of course, what you talked about is very real. Many people got locked into mortgages at 2.65%, 3% interest, and they're looking at rates today at 6.5. So they are, people don't want to talk about it, but they're kind of prisoners to their home. They live in affluent areas all over this country. They look like millionaires. Maybe they are millionaires, but the reality is they're kind of prisoners because it's 6.5% interest on a new home, and they're paying 3% now. They're sticking around. They're not moving.
On a $1 million house, it's $30,000 a year. On a $2 million house, it's $60,000 a year. Just to move costs you that just to start with. Paul, what are some of the most interesting issues that you're looking at in real estate right now? What do you see as some of the most interesting issues that you see?
Exactly what Rick was saying, to his point that a lot of people refinanced during the COVID time period, or they purchased and then they bought, it was at 2.5%, 3%, and they want to sell and they can't because where are they going to go? Or they can't even refinance, for sure, that's out. So where are they going to go and find somewhere else where they're going to pay 2.5%? The rental prices right now are really high. So it is like a catch-22. It's a little bit of a struggle. The wealthier people can seem to manage it because, or not even, middle class, because maybe they have some funds saved up if it's worth it. They want to be closer to their grandchildren. So they're going to make the move. They're going to bite the bullet. They're going to take that hit. And that's okay for them, but it's not okay for, let's talk about the Gen Z market, the younger kids that are doing everything right. They're working hard. They're working hard. They have jobs, they're saving money, and they're trying to buy, and they just are kind of chasing this ideal of home ownership and that American dream, if you will. And I know that I have 3 Gen Zs kids, and they're, my oldest one, who's 27, lives in Lincoln Park, has to keep renting because to put down 20% or to get into a bidding war, right? And you want to pay more than what it's worth. He's got to get a loan. Then it's not going to appraise out. So the person who has the mortgage, who doesn't have the mortgage, who has the cash, is willing to, who cares? They don't have that appraisal issue. So there's some things at hand. It's not all doom and gloom, I promise.
But take a second, because we see again more transactions again getting done. It seemed like a few months ago it was really soft in the North Shore in this area, just because there's not enough houses to buy. And exactly what you talked about, 10 bids on a house, and the parents show up and help the kid who's got, the parents who have money, they backstop the kid, and then the kid's got a whole different game compared to other people that they're competing against. But talk about the Florida market. What do you see in the Florida market? Because you also spend time helping buyers and sellers there. For a while, that seemed to be just on fire. Is that still on fire? Is that softened? There's been so much building there. What do you see there?
So the Florida market has softened for sure. And this year, we saw a lot of price reductions, where that wasn't the case before. It was, again, this whole frenzy. People were coming to Florida, moving to Florida from, the Midwest, New York, and the whole COVID issue, post-COVID issue too. And then now it is the construction, they're still building a lot, but there's also a different issue in Florida because of this there's a lot of HOAs there. And there was this issue with the HOA when the building collapsed in Miami. And then there's this whole reevaluation and reassessment now, and all these special assessments coming up. So Florida has a whole different problem on its hands in terms of that. It has slowed down. The prices are lots and lots of price reductions. I mean, homes selling for $75 million, which was like the norm truly 2 years ago, are now, they're at 50,000, or I'm sorry, 50 million, not 50,000, 50 million, or, then your normal bracket, you're in like, the millions, but it's a different market there than here for sure. It's wild. It's like the wild, wild west in Florida. But
you are seeing, though, more and more what people call price improvements. We call them price reductions, but people call it price improvements in the marketing and stuff like that. Yeah. Kenny and Michael, the sort of movement towards, there's a question from the audience about the change in workforce, how workforce is less focused on the big office buildings in the central cities. Does that make a difference in your business, in your locations? Like at one time, some of these buildings built near North, River North, were built in part to help accommodate people that would be living and going to work in big buildings in the Loop. Any changes that you see because of how the workforce now works, remote and hybrid and so forth? I see Dylan Warner's joined us, one of our sponsors, great leader. Dylan, we'll ask you to go off camera for a few minutes and we'll be back with you on the next panel. Thank you so much, Dylan. Kenny and Michael, any thoughts on sort of workforce redistribution and what it means for the rental market?
Well, I mean, what we're finding is, and Michael can speak as well, I mean, you're talking about people working from home instead of going down into work in the Loop. I mean, that is
and just office product has changed, obviously.
Yeah, there's
people are moving out of big office buildings into smaller size neighborhood buildings.
Wait, go ahead, Michael.
Well, I think we've seen, yes, there's been a lot of change. I think one of them that comes to mind right away is that we're actually buying some of these smaller office buildings and converting them into residential properties in areas like River North, for example, which is happening, like everywhere in River North. I think Cranes or someone just posted an article about it the other day. And so not only are we seeing that some of these, that people aren't working in the Loop, they're converting everything in the Loop to residential. And I think from sort of on a more granular level, we're designing apartments today when we rehab properties to accommodate people who don't go into the office. And so, when we're designing buildings, we realize that, we have this joke in our business. When we walk through a building, for whatever reason, we have to bring someone through it, insurance, appraisal, everyone's always home. I mean, I think I could speak for most of us. I mean, I was never, I'm still never home. I mean, I like to get to my office. When we're showing everyone's home, you have to, and then of course there's you have to give them 48 hours notice, and nobody wants you in their apartment because that's become not just their home, but it's become their workplace. And so, I think there's been a big change, and I would say
it also changes how we develop property on our business. It also changes how we develop property. If you think about it, people are home all the time. I mean, they're in their building and in their unit. So we're now looking at adding amenities that we would never probably have done in smaller 36-unit buildings. We're talking about adding rooftop decks or gyms in the basement or co-working spaces in the basement, stuff that we would never have done 20 years ago.
Well, and if I might, Ken and Michael, I'm sure this amenity everybody wants, a package room. Because everybody gets their Amazon packages. You need a secure package room. And I know Paula wants to say something, but Scott, I think your listeners will get a real kick out of another asset class, which I see about to change in a big way, are parking garages. As you know, I spent a lot of time in California, Los Angeles, and San Francisco. You look to your left, you look to your right, there is no one driving the automobiles that are driving next to you. So when you look at all the parking garages, especially in the central business districts of this country, I feel that those cars won't need to park in the garage because your car will let you off. It won't go park. It'll go out and make you money by picking up other people during the day if you so wanted to. And the parking garages and the apartment buildings themselves that have garages inside were not built to hold the electric cars, which weigh 3 times more than the internal combustion engine cars. So there's going to be a lot of central business district real estate that's going to have to be well thought of. And even though Michael and Ken are doing it, a lot of the floor plates in the office buildings just don't lend themselves to conversion to residential. And therefore, like we used to see in Las Vegas when the old casino would get knocked down, some of these nice looking office buildings around the country are probably going to have to be torn down.
Yeah.
Crazy.
So true.
Just crazy.
Yeah.
Rick, thank you. Paul, you were going to say something. You were going to add something.
I was going to say, I think you guys, Rick and Michael and Ken, you guys should open up a couple of cafes around Lincoln Park because, again, I have 3 Gen Zers and these kids are a lot of kids, not all of them, of course, but are in tech. And in tech, you're working from home mostly. 70% of these kids are. My oldest son is always at the cafe. He says it's a cafe. Everybody's working there. They have their computers. They're able to tune out, or they have their earbuds on, and they're just working. And they're doing data analytics online, and they're really working and they're really focused. But it is different. And my other son, who's in imagery and different, he has to go to the hospital. But that's a whole, it's a different. It's not the tech. It's tech, but different. Where he has to be in person. But a lot of these kids graduated with computer science degrees or econ and such, and they love it. I mean, my son's perfectly happy going to the cafe every day and working for 5 hours.
But Paula, aren't we concerned that when these kids graduated with computer science degrees and they were told to go into coding about 10 years ago, aren't they all going to be unemployed? But thank goodness they'll all have guaranteed income from the government. Isn't that the future?
Let me ask a different question before we get into a whole different discussion down that route. But let me ask you this question. I'll ask Rick, Kenny, Michael, Paula this. The most interesting thing you're watching in real estate right now, and Kenny and Michael, I'll start with you. Rick had mentioned what's going to happen to these big parking lots, what's going to happen to these big commercial buildings, big office buildings, some of which can't be converted to residential, and some of them still have pretty good vacancy rates, some don't. But Kenny, Michael, the most interesting thing you're watching in real estate right now, and then Paul will ask you the same thing, and Rick, you too. Kenny and Michael.
Interesting thing I'm seeing in real estate.
I mean, I think the adaptive reuse from office to resi is one of the most interesting things I'm seeing, because it's not like, Kenny and I always say, like, we're never the first ones in, we're never the last ones in, but we get in relatively early. But as I'm looking at that space now, we just came, our afternoon has been insane because it always is, but we during your panel, we ran to go look at an adaptive reuse building in Fulton Market. And it's a beautiful office building, 7 stories, timber loft office. And it's essentially 50% vacant. Kenny was walking through this one office that was 100% vacant, had the nicest desks, 1,000 chairs, and nobody was in there. And it's like, to me, that's kind of the most interesting thing that I've seen, because people are always building ground up. People are always taking these neighborhood walk-ups and rehabbing them, and that's been going on for the 30 years we've been in business.
What I think interesting, and maybe I'm in the minority, I think people are looking at renting as more of an asset than buying. You said it's hard to buy. The barrier to entry into owning real estate is extremely difficult, and there's nothing wrong with renting. It gives you you don't have to fix anything. You can move when you want, and I really do believe that that's become more of an asset and not looked, you don't own. No, I think renting actually opens a lot of doors. And I think
I couldn't agree more with you, Kenny. There's a whole generation of people to be renting versus buying just because it gives them flexibility. They're paying maybe a premium a little bit, but not even as much anymore for that rent versus ownership, but they don't have all the risk of holding the property.
Not to mention, Scott, that they can move to a different state and work remotely. Right. So they're not down to a mortgage, to having to sell a home.
30 seconds on the cost of adaptive reuse, adapting, some of these, some are impossible, some are doable. How big a challenge is the cost, or is that every building's different in terms of the ability to change it to residential?
We can speak directly to that. And Michael, and I can. We are doing a building right now that, let's say, we figure to be at 165 a foot. We'll be lucky if we get it done for 200 a foot now. So I'm the divide between building new and these adaptive reuses is getting smaller and smaller, which is why Mike and I have started to look at building ground up construction. That's what we're
smaller size. I think we would, if anyone asked us today, we would say without question, if somebody could find us land in a well-located area, we would rather build a 5-story 50-unit building than rehab than an adaptive reuse 50-unit project.
God, just because so many different complications.
Yeah,
Paula, let me turn to you. I got to wrap up this panel shortly. Paula, the most interesting thing that you're seeing currently.
Just that the market is starting to equalize a little bit, which is great. I love that because, and to what they were saying too, is that talking to some of these younger folks or just people who are renting, they're not seeing it as a loss really. If you talk to somebody 5 years ago, they're seeing it as right. The flexibility, it gives them flexibility, it gives them options. They're not locked into something, so they're turning it around and looking at the positive. Because they don't really have a choice, to be honest. And so, and the rents aren't as high as they were too. So it's interesting. I think, by these office buildings can be converted into multi-use also, which is good. It seems like a lot of the Gen Zs are really looking for, they want everything to be easy. They want it right there. So if you can build, a coffee shop, a this shop, a that, and have a few residentials above, you're in good shape.
Fascinating. I know that in the building downtown that one of the kids lives in, it's exactly that. They've got the Goddess in the grocery on the first floor.
I love it.
Got the building,
and they'll pay premium for that, no problem, because everybody they like the easiness of it.
And the amenities. Rick, you're in a lot of different markets. You see a lot of different markets. 30 seconds on the most interesting thing you're watching right now.
Well, the most interesting thing I'm looking at is data centers. And to that end is how are we going to get the power to power all these data centers and the need for water. And a lot of municipalities don't want it. And that directly affects, Scott, our 401k and our IRA, because a lot of our high-flying stocks require these data centers. And a lot of these municipalities are saying, not in our town, don't build it. So really the energy infrastructure, we all take it for granted, but I believe it's everything. And it's going to be such a political fight. And is our electrical rates going to go up? And
we watched this years ago with the phasing blackouts in California for a period of time, and that's something our country is not used to and does not like. People don't like that, not having their energy when they want to have it. Fascinating. Kenny and Michael, I want to thank the both of you, Rick Levin as well, and Paula. Always fantastic to visit with you, the best in the business. Paula, thank you so much. Thank you, folks.
Thank you guys very much for having us.
Thank you, Scott.
Paula and Rick.
Always a lot of fun. We've got a great panel coming up on talent and recruiting, what's working, what doesn't. I am thrilled to welcome our next panelist. We'll try and keep ourselves relatively on schedule here. Chris and Dylan, if I can get you folks to put yourself on camera, would be fantastic. Thank you so much. Great. Let me start by asking Chris, Dylan, Aries, and Jeff to introduce yourselves. We're going to talk about talent and recruiting, what's working, what doesn't, and a lot more. Chris and Dylan are both founders of their own firm, just tremendous entrepreneurs I have great regard for. Can I ask the two of you to start by introducing yourself? Aries Clapper's fascinating, a lawyer by background, and also brilliant speaker on the imposter syndrome, which is so close to recruiting and employment and people and where people belong. And then Jeff Friedman, private equity engagement listener, and also ModMed and CEO Whisperer. Thank you. Chris, Dylan, let me start with you two. Chris?
Yeah, Priority Search Management was founded almost 10 years ago. Coming out of executive search, what I saw was a need in what we call the missing middle. It's a little cheesy, but it's memorable. So that would be that mezzanine layer below the C-suite or the executive suite above the hourly. So our focus is helping investment-backed companies or scaling organizations increase top line, protect their bottom line, all by putting in the right folks at that mezzanine level that are protecting their profit and carrying out that strategy and executing it boots on the ground. That's where we focus and what we do.
Thank you, Chris. And Dylan, talk about your business, and also you've got a side business and also a growing family. But tell us about your business, the core of Elevate.
Yeah, so I am one of the co-founders of Elevate Talent Advisors alongside my brother, Brett. I come from more of boutique style recruiting, always was a 1099 or something into a smaller firm. He comes from Robert Half, Judge Group, more corporate recruiting. And we decided to, put our focuses together and start our own. So we focus on permanent full-time placements. Our niche is that we don't have a niche. Anybody that gives us a shot, we will find a way to make it happen, whether we hire someone that's an industry expert to help us find talent or, other industries that we've recruited in the past. Scott's alluding to a lot of pounds ago, I was a boxer. So I have my own little boxing training business that I do on the side. My brother runs a really good sized AAU basketball program. So we're just out there trying to make money and helps us make connections everywhere we go. And then I have a 5-year-old, a 4-year-old, and a 3-month-old. So if you hear somebody screaming, everybody's okay. They're locked in their rooms. They're fine. Business comes first. So
it's a growing family and as good as they come. Aries, tell us about yourself and about what you do today.
So it's nice to see you again, Scott. As you know, I am an almost completely retired lawyer, but for projects here and there, I'm a pretty active freelance writer, and I'm a certified executive coach. My specialty is imposter syndrome navigation and management, but I help executives and healthcare leaders in all aspects of the job. I have a master's degree in industrial and organizational psychology, and I think everything I've done speaks to my absolute fascination with the psychology of work. We spend so much of our lives at work, and I want to know everything that's behind that. I recently launched a podcast that I host. It's called Beyond Your Job, and we explore work-life balance, everything in between.
Fantastic. And thank you so much for joining us, Aries. And Jeff, can you take a moment to introduce yourself?
I'll make this very brief. I'm downstream from all three of these people. Frankly, I'm disappointed I didn't know them when I was the CEO of a ophthalmology business, of a dental business. I ran oncology clinics. They are, to me, in just their introductions, different from the people that represent those roles. And I'm not saying that to glad hand. I'm just telling you that there's a practicalness that I just heard from these three people. And in all candor, the last hour and a half, this is like a master class. I hope I know it's being recorded. There's a lot of great stuff going on here. I don't think we'll get to this meaty topic in 30 minutes, but less of an introduction, more of a this is how I'm feeling, listen to this, and this is what I'm interested in talking about.
Well, Jeff, thank you, and I appreciate it so much as always. You're literally the best. And I'm gonna start with Chris, go to Dylan, Aries, and Jeff back around, and I'll try and intersect the different questions that we've got here for each of you that make sense. Chris, I'll start with you. What hiring strategies are working best today? What's going well? What's not going well in the hiring business and getting companies the right talent and getting people the right roles?
Yeah, what I think is going well are the clients that we work with that are more proactive in pipelining what they need. So they have a clear current picture of what their capabilities are internally, and they're taking action on it, meaning they're not being caught when somebody leaves or exits or the landscape changes and they're having to be reactive on hiring. The ones who are doing it well and what's producing the best results today are the ones that are proactive pipelining. So for, let's just say, an investment-backed healthcare company, if they know their clinical operations are going to be growing, they are looking at what type of clinician they're going to need or what type of leader they may need in that setting. Same could be if they know they want to continue to scale and grow. What does their referral pipeline look like? Do they need to add a business development or commercial layer? So the ones who are building a proactive pipeline are doing it well, but it only works if they have internal clarity on what those needs are. So they're not taking it for granted. They're not being reactive to it. They're being proactive.
Thank you very, very much. And Dylan, let me ask you this question. Where are companies struggling to find talent? Where do you see the struggle to find talent? Where is it easier to find talent today? Is there a mismatch between people's qualifications and what companies need? What are you seeing out there?
Yeah, I think the place that most people are struggling, especially who we're working with, is that mid-level either sales role or leadership role. People, it's easy to find the college grads right now. Unfortunately, most of them are coming out with nothing to do, so you are getting hit with hundreds of applications a day. And still, with a lot of senior type roles are easier to find because people have built a network, like Chris is saying, over the years of high level people that they have talked to that they can reach out to. It's really finding that mid-level person. And the struggle is, what do you do in that situation? Do you hire internally and hire someone that's just kind of worked your system over the years, or do you go out and find someone with a higher trajectory? And that's where most companies are struggling today. I think a lot of companies are looking internally, and I totally get that. They want to promote within their company, but they're missing out on so much talent out there. I've got people that have such higher trajectory and that can come in and kind of, mess with the status quo over there and stir some things up to help the company grow.
And let me ask you both this question, and then I'm going to move to Aries and Jeff. Dylan first. Someone comes to you looking to fill a spot. What's the first thing you do with trying to help them fill that spot? And what does that look like today? How much of that is technology driven versus just your team and people reaching out to people? What does that look like in trying to find candidates today?
Yeah, so I think as many good recruiters do, we come in with a consultative approach as a consultant, as a partner of our client. So first, I will say to the owner, have you gone to your top people, the person that you want to replace, and ask who they know? We all know you are who you hang around. So if you want someone exactly like your top producer, your top operations rep, or whoever in that seat, chances are they probably hang around that person or know a competitor of theirs that they can reach out to. That hurts my wallet directly, but it's always my first question. And then I go to my network. Who do I know? Who can I reach out to? Who knows who? I want to play the referral game in my seat as much as possible because I come in with credibility right away. I know somebody that knows this person that can vouch for them. Now I put my name behind them, someone else's name behind them, and they look that much better when we submit them to a client. And then third, we use all the tools, LinkedIn and whatnot. We'll go to that as our tertiary, objective there because that's how we find people that we've never heard of before. But other than that, plug and play, ChatGPT, Claude, whatever you need to use to find somebody.
No, fascinating. But your point is so well taken that so much of it starts with networking and referring and knowing people because you have a better sense of credibility versus a total stranger. At least work in the networks. Chris, your thoughts on that? How do you sort of go about starting somebody's search and starting to find them the right people?
Sure. I'm going to steal a phrase that you said months ago, Scott. It's hand-to-hand combat. So it really is about relationships. We definitely utilize AI on the front end, but every search is bespoke and it's custom. And the database that we have is a living, breathing organism. So whatever worked today is likely not going to work tomorrow, and people's lives change. So while we do have a network, we want to make sure that we're covering the universe of who is in that role today at like companies. So we'll leverage AI on the front end, but it's hand-to-hand combat going forward. It's about how we reach out, the message that we tell, because there is PE skepticism. We work with a lot of investment-backed companies, and at the level we work at, there's PE skepticism. And so it comes down to explaining that impact and the culture that they're going to step in. But that is how we do it on the front end.
Thank you very, very much. Aries, you spend your time really focused on a really interesting issue, which is this concept of the imposter syndrome. And most of us at some point in some role have felt like, am I really the right person for this? Am I prepared for this? Am I in the right seat? Talk a bit about how you got so interested in this area and where this could fit into the recruiting and talent and team building discussions with companies or with an individual trying to present themselves or be confident that they're the right person for the right role?
So that's an excellent question because you're talking about both the potential candidate and the recruiter. And I think that it really just starts with education. There's so much information out there today on imposter syndrome. There's also a ton of myths, and I know you and I have spoken about that. It's important to get real research-based information and understand what it is, what it isn't, and how it affects individuals. And then I'm not suggesting that anybody diagnose anybody else, but having some sensitivity and empathy to the candidate who is having an interview and has a great skill set, not just a whole bunch of fluff and filler on the resume, but actual experiences, and are maybe selling themselves short. So that's a place where working with a coach, and I mean, the truth is I normally come in on the back end when there's a problem, not so much on the front end, but having that education and understanding what the issue is that could be a barrier to hiring somebody amazing. I also want to mention that imposter syndrome disproportionately affects marginalized groups, women, neurodivergent individuals, so they may present differently at an interview. And without the sensitivity and the understanding of what's going on, you might miss out on a great candidate whose resume got through no problem with AI.
But talk about that, because sometimes people undersell themselves and end up being really great candidates because they're a little bit shy, a little embarrassed, but that doesn't really show the real motor, their underlying motor and drive. And how do you try and recognize that so that you're hiring the right person, even though that person might not have the confidence that we think they should have?
Go ahead, Scott.
Well, we often find the other thing where people are overselling themselves, and all of us as recruiters can't stand that.
Right.
But the person who really has a deep motor, they might not have big charisma or that outgoing, but they're actually fantastic. How do you get them in the right mindset?
So a couple of thoughts. I've been asked before if arrogance is the opposite of imposter syndrome, and the answer is no. You can be an arrogant person. It has nothing to do with imposter syndrome, and vice versa. Same with perfectionism. So again, understanding what the issue is. A person who has a resume filled with fluff that is all form over substance, a good recruiter is going to be able to get to the bottom of that, or in the secondary and tertiary processes of the interviewing process, because people are going to ask exactly about the experience. So once you take away the millions of certifications that are all available out there online and build up people's resumes and make them look like they've taken every class under the sun, once we take all of that away and we're having a conversation about actual experiences, describe this project to me, describe how you solve a problem, what happens when you disagree with someone, whatever the questions are, and I'm not the expert on HR, whatever the questions are, you get to the bottom of whether that person is experienced or teachable. Because to me, somebody who is motivated and somebody who is coachable is a great candidate. Agility, transferable skills, the ability to learn, and the ability to be a great team member, because that's what creates a great environment. It's everybody in the team. It's not just the person. And I just want to touch on one last thing. I don't love vague notions of cultural fit in interviews when people say, oh, this person seems like someone I could really work with, or they remind me of someone that I work with now, or they remind me of myself. We all do it. It's unconscious bias. We can't help ourselves, but we need to be conscious of it, because that's not really structured. And I'm not sure if Dylan and Chris would agree, but year after year, the research shows that structured metrics where we can actually compare metrics one to the other, along with really thoughtful questions and a holistic approach, really produce the best results. There's no way that we can sit in front of someone, and no way that we should, and say, oh, this person has imposter syndrome.
But you've said something that's really important, and it's completely changed the face of sports and talent evaluation, and well documented. Like the Moneyball movie is a great movie about this concept. Is this concept that people used to judge somebody? he looks a certain way, she presents a certain way, she talks to me a certain way, versus really digging deep at what they've done the last 10 years and their stats and so forth. And they would overemphasize sort of like the personal qualities versus actually what the person does and their actual motor and their record. So I love your point on that. It resonates so well in what we've seen over the years in hiring ourselves. Jeff, you've been in charge of building executive teams and leadership teams over a long period of time. What advice do you give to people in building leadership teams? How do you sort of fill out a leadership team? How do you evaluate talent? How do you work with people like Chris and Dylan in the search business? How do you think about these things?
Yeah, so this is an amazing topic and impossible to do in a short period of time. Obviously, this is
Yes.
I think about this as sort of the least amount of work for the biggest amount of impact, which is people. And it's not that there's not work, but it's the biggest amount of impact. So one of the things I've heard at least two of the three other panelists say, which is an answer to your question about advice, is this idea of education. I'm going to make a bold statement, but I'm just going to say it. I'm just surprised at how many people have gotten to a certain level of their career and they don't know how to interview people. We all talk about the candidate. You got to be prepared how to, candidate, like do this, do that. And Eris, you're just saying like, come off this way. And all that's really important. But I'm stunned. How do you interview people? You just said, Eris, I got to get at this topic. I have been on more interview panels and I walk away. I got really classically schooled when I was at Gallo Wine in the 80s on how to interview. And I go, how did you miss that in that person? And it's because they just aren't educated on how to interview. So that's one point. My second point is the research will tell you that when you align incentives, good people will perform better. And in healthcare, think about a healthcare practice. If you align incentives and you say you're going to have a piece of the profit because you're going to do your thing better, making sure you don't get in the way of clinical care. You don't want to ram something down somebody's throat and it's going to change the outcome of the patient. But aligning incentives is an enormous piece of advice that I would give a CEO. And I would end by the following statement. This is your single biggest priority, bar none. There's nothing close. When you do it right, organization successful. I have failed at this more times I can tell you. And I look back and go, God, it was so obvious. But if you prioritize it and get the coaching, all you guys are great at this, man, you'll get a great team. But if you make it like your third thing, I got to get my investor happy and blah, blah, forget it. I'm being bold, but that's how I look at this after a lot of years.
No, I love that. And I also have this concept with managers. Every hire you ultimately make is a little bit of an educated guess and a gamble. And almost the worst thing that could happen is the hiring person getting too gun shy about hiring and also not learning what they should be looking for as they hire. Chris, what do you see companies doing right in hiring? And Dylan, I'm going to ask you the same question. What do you see companies doing right in their hiring today and recruiting today?
Yeah, I think that those that have a clear picture of what it is they need, what the business needs, not necessarily what they want, and they approach it with some impartiality. Going back to Eris's comment, and by the way, I do agree wholeheartedly with what you said. There is, Jeff Smart calls them voodoo hiring practices. I want somebody that I can get a beer with, or their spirit animal needs to be a cheetah, which none of that makes any sense. But I think those that have a clear picture of what it is the organization needs and then can lead to that and hire the right people based on what the organization needs. And I'm going to steal what Jeff just said. I thought it was brilliant. Align incentives. I've heard leaders say, I want them to take ownership. Well, give them ownership. They can't take something that they don't have. So if you align incentives, and again, with we work with investment-backed companies, so there's some PE skepticism out there. But if you can align incentives, really talk about what the organization needs, share with that individual how they get to move the needle so that they can come in with clear vision on what it is they're going to do each day and what that outcome is going to be. That is something that fewer organizations do, but the ones who do it, they get it right.
And how important is it, to put together that list of here's what we're looking for in somebody, here's what we're looking for in that position. How important is that? And then how do you be careful not to turn that list into 80 things so that you're making it useful versus just a game to develop a big list?
Yeah, it's the old proverb of give me 6 hours to chop down the tree and I'll spend 4 or 5 sharpening the axe. They really need to focus on the tool to make the job easier. So it's critically important to put that list together. And yeah, we can all make a big list, but that's where it comes to the senior leadership having a seat at the table. In each one having that seat, knowing where the organization is going and how their function aligns with that particular outcome. Good CHROs can see that talent need, put together proactive pipelines, understand which functions maybe have the clearest path to the outcome and which ones don't, and then focusing those efforts and needs there, whether it's internal talent acquisition or using a partner like Dylan or myself to come in and help augment that as an embedded partner.
Thank you very, very much. And Dylan, as you see companies doing this right, really doing a good job finding the right talent, placing the right talent, what are they doing? What are the organizations doing that you think handle this right? Because there's this great balance between pace. If you're too slow in moving forward in your process, you lose people always, particularly the good people. At the same time, you want to be deliberate and thoughtful about getting the right people. How do organizations do this well?
You just answered the question right there. It's all about pace of interview and coming in prepared. I can't tell you the amount of times that I've sent people on interviews and they will have the first round and went great, and then they go, well, we have to figure out who they want to talk to next. And I'm like, well, we don't know who they're talking to next and when they can get on the phone. And all of a sudden, a week goes by, 2 weeks go by, and that candidate is also in an interview process somewhere else. And that company has it streamlined. They have it down packed. It's 3 phone calls. HR person or internal recruiter, person that they're reporting to, and owner of the company, if it's a small company, however you want to structure it. And they say, wow, this process was great. And that's the type of company that I want to go with. I tell all of our clients, yes, you are interviewing, but so are the candidates. They're interviewing you on if they want to work there. So don't just think this is one-sided. Is this person going to come on our team? They're thinking, should I join your team? And the best companies are the ones that are going into that call just as nervous as the candidate saying, man, I hope we do this right to get this person to want to join us.
Yeah. Are you somebody that wants that somebody wants to work for? I mean, that's what you're saying. Sorry to interrupt you, Scott, but
no, perfect. Yeah.
Yeah.
But I think that's so important, Jeff, because if you went back, you and I are old enough to go back to the era where we used to say it was more important to be respected than liked. Yeah. And today, as a leader, it's really got to be both, right? You don't have to be go having a beer with a person, but people got to believe that you care about them and you want them to thrive too. And it's got to be true.
Yeah, the data is still true that it's probably not the money that makes you leave. I didn't connect with my boss. It's, that you have to be that person that somebody wants to work for. And if you don't know how to interview, you don't have that style, that chemistry, you're going to get the wrong person. I mean, it's just factual. And you guys that are doing this every day know that. Sorry, Scott, I didn't mean to inject that. It was such a critical.
No, thrilled to have you inject. Aries, any thoughts you want to add into this? Because you've seen this. Obviously, you're a professional coach today, spent a lot of time around the imposter syndrome, but also have done a lot of hiring, a lot of working with people. Any final pieces of advice for either candidates or companies in the talent and recruitment era?
I think that what ties in what everybody said here today, I don't want to speak for anybody else, but I think we might agree that it can't just be transactional. It's about building relationships. That's why when a candidate doesn't get a job but walks away and says, okay, but that was a fair process. I had the phone call. A week later, I had a second phone call. I knew what happened. I was kept abreast of the situation. I didn't get it. That didn't work out. I'm disappointed, but I'm not feeling badly about the process. I'm not trashing the company. And that's just the right thing to do, not just because we want our reputations preserved, but because it builds relationships and it's important for everyone.
Thank you very, very much. Let me give you, Dylan, any final thoughts that people should be thinking about in the recruitment process? And then Chris, I'll ask you the same question, and Jeff, you too.
Yeah. The recruiting process is all about the person-to-person connection. There's obviously, you need your AI tools and everything to keep up with, the industries and all that. But, the true hires are someone that we feel like that we have connected with person to person. So when you post a job on LinkedIn or where have you, and you put in your keywords and you're only getting your resumes up with the people with those keywords, you're probably not finding that right person. I think the interview process, to keep saying it over and over again, is to make sure that you really connect with somebody there and not rely too heavily on technology.
Love that. Chris, any final thoughts?
Yeah, I'd say what Dylan said, and I'm going to steal something from Eris, is be proactive in your pipeline, but also bring authentic culture proof points to the interview process, not just generic narratives. Really talk about, going back to the process, sell first, then qualify, gain interest, build relationship, I like to call it give a crap, just give a crap about the other person on the other end of the line. And if it doesn't work out, that's okay. If you have a legitimate process, you understand what your culture points are and what the needs of the business are, lead with those in your interview process.
Love that. Jeff, any closing thoughts?
Thanks for making it the last comment. This has been an amazing day. I say that genuinely. This is something that you should look at the recording. I'll give my summary on the point that I think is so critical. I don't know that we have a talent shortage, and maybe the data would say otherwise, but we definitely have a shortage in how to pick the right person. And that comes down to whoever the leader is that's making the hiring decision has made more bad decisions than good decisions. Get educated. All three of these people can teach you how to find that real, that nugget, that connecting point. But if you don't do that and it's, oh, I really liked him, let's hire him, that person rarely works out. So make it an education if you're an executive trying to hire somebody.
Eris, any final thoughts?
I think that people love to talk about a shortage of talent out there. So I'm definitely piggybacking on Jeff. I'm hearing about that a lot. And I don't think that that's what it is. I think that there's a disconnect and a gap between, yes, rapidly changing needs of organizations, but organizational lack of a reluctance on the part of organizations to be specific in their job descriptions, to say what it is that they need, and then to actually invest in the people. Because if there are rapidly changing needs, then there's also a rapid change for education and for training. And so I right now am not buying into the idea that there is a shortage of talent. I think that there's a disconnect, and I think that there's the return to office policies, which we've seen over the last 2 years, and different generational differences that we see. And I know that I come at it from a psychological standpoint, but that's what causes the disconnect. And then that kind of lack of professionalism and education on how we drill down and make those connections leaves us in this position that we're in.
Thank you so much. Chris Lacey, Dylan Werner, Eris Clapper, Jeff Friedman. I want to thank all of you so much for joining us this afternoon. What a pleasure to visit with you. This is our next to last session. Tom and I will talk for about 20 minutes plus here. The last session will leave to about 10, 12 minutes at most, so we'll get everybody out of here about 4:15. Tom, I want to thank you for joining us again. We're going to talk about several questions around sort of the deal world, the ESOP world, and how this may evolve over the next sort of decade and what you're seeing and a lot more. Tom, as we get started, let me ask you to take one moment to introduce yourself. You're the managing partner of Perpetuate Capital You are focused today on ESOP transactions and advisory. I've also had a chance to visit with you over the course of the last 25, 30 years, worked with you on a company that you founded called Regent Surgical Health, built one of the most well-known ambulatory surgery center companies in the country. Used an ESOP there, became very excited about the potential and the ability to use ESOPs for transactions, and now are in the ESOP world yourself. Also a Harvard Business School graduate, one of the brightest people and the most ethical people I've ever had a chance to work with. Can you take a moment on an introduction of yourself? Then we'll talk about the silver tsunami, retiring business owners, and a lot more. Tom?
Thank you, Scott, for allowing me to participate, and it's my pleasure and privilege to be here. I am a general partner of Perpetuate Capital. We do two things. We do consulting for companies that are in transition, and we will do feasibility studies for them to determine whether they should go to a strategic partner, they should go to private equity, or they should go to an ESOP. And those feasibility studies are kind of the beginning part of the analysis to help give them a direction on which option they should pursue. We will then, if they choose to do an ESOP, we will consult with them through the entire process, make recommendations on advisors, and it's about a 3 to 6 month process. So it's not a simple thing, but it's like golf. It's simple, but it's not easy. As you give us your golf analogies in your daily reports, Scott.
Well, my golf is a real struggle. So I hope that there's better answers on the ESOP side than on my golf side. It is a constant challenge. Tom, I'm going to ask you 5 questions. We'll start with, everybody's talking about the silver tsunami of retiring business owners. They talk about this incredible both wealth transfer and also just the amount of businesses that were founder-led, almost mom-and-pop businesses. Many have grown into very large businesses. What's a number that people aren't paying attention to when you look at this tsunami of change?
$10 trillion. That's the value of the middle and lower middle market companies owned by baby boomers. And they're all going to transact, either warm hands or cold hands. Warm hands, they're alive, they're figuring it out. That's about 40% of the owners. 60% of the owners are basically cold hands owners. They're gonna be there until they die or until they go into the home. And those are the people that really have a problem. Their employees have a problem, their customers have a problem, and they're the ones that we need to shake up and wake up to the situation that they're in.
Thank you. That's a fascinating stat because, quite frankly, if you have a company, particularly a privately held company, it depends on the size and structure of that company. But if you leave that for your children who are not involved in the business, or even if they are involved in the business and haven't figured out what to do with it, you could really leave the next generation, whoever's left, with horrendous challenges and problems if you haven't solved for this up front, or at least thought about the transition and what you're going to do.
That is correct. And it's you're not doing your family, your employees, your customers any favors by not planning for a transition while you still have warm hands.
Thank you so much. There's a perception out there that when you do an ESOP transaction, that you might be leaving money on the table, that you could make more money by selling to a private equity-driven buyer, a financial buyer, maybe a strategic buyer. Talk about that. Is that a fair perception? Are there spots where ESOPs can deliver the same results or better financial results than a private equity or strategic buyer? What have you seen? I know you did an ESOP deal and then a private equity deal with one of the companies that you founded. Give us a little bit of the economics of ESOPs versus the other alternatives.
Your question is a misconception by most people. the ESOP has to pay market value for your company. Market value would be determined pretty much by a private equity firm or a strategic. Certain strategics are willing to pay a lot more for your company than private equity will, because they're going to take a third of your employees and fire them. They're gonna do away with any kind of community support or philanthropy that you've got. Any dollar that doesn't go back into the company or into their pockets, that's what they will eliminate. So they can afford sometimes to pay more than a private equity firm. But the ESOP is basically targeting off the private equity price. We had an offer for our company, and the ESOP matched it. What the ESOP will do, though, is it will allow the seller to roll their proceeds into stocks and bonds of U.S. companies and delay until their death any capital gain tax. And if they hold those assets until their death, the capital gains goes away. So that's one of the big things that people look at when they consider an ESOP, and it can really put a huge advantage over a private equity deal where they have to pay capital gains.
And take a second on the private equity deal. So many deals in the last 10 years have been done through private equity. When an owner sells to private equity, what changes for them on day one, and how is an ESOP different on day one?
God, that's a great question. Day one, the private equity company owns your business. If they've bought 51% or more, they might as well own 100% because they call all of the shots. You may have rolled over 20, 30% of your equity. You may have an earnout on the deal, but they're going to make all the decisions. So ultimately, if you don't agree with their decisions, you either leave and then fight over the earnout and the residual equity, or it's not a simple solution. For the ESOP, there is a trustee involved. An ESOP fundamentally is a trust established for the benefit of the employees that they get the benefit from, but they don't own any stock. A trustee is in place to represent the employees on distributions of shares over time as the employees earn those shares. The trustee basically hires a financial advisor to give an annual valuation of the business, but the employees never run the company. The company is run by the board that hires the trustee, and the trustee hires the board, so they have a mutual interest in working together. And the trustee never wants to run the company, and the employees never get to run the company. The board continues to run the company while the ESOP is in place.
Thank you very, very much.
So, to finish answering your question, I'm sorry, the board then keeps everything the same. If the company is doing philanthropy in the community, if the company is has a certain mission that they're committed to, certain customers they're committed to, they just continue operating the business as it has been.
Thanks. So you literally have a capital event, a financial event, but very little change to the actual running of the business day in, day out. And it's why some of the most famous companies in America have been ESOPs over the years, to be able to maintain the culture, maintain the company, and at the same time, take care of some of the financial needs you might have to take care of with some retiring owners or shareholders and families and so forth. You had mentioned a stat earlier that when you did an ESOP transaction, you were able to help turn, and you'll remind me of the number, several of the rank and file employees into millionaires, some of the billing clerks into people worth $500,000 or more. Take 1 second on that, and then I'll ask you to tie that into a separate discussion, which is this section 1042, and what does that mean? But first, give us the story of how well some of the rank and file employees did with your ESOP transaction and the growth of your company?
We decided in end of 2016, to convert our Regent Surgical Health surgery business to an ESOP. We had 24 centers. We had like 4 under construction, and the 14 original owners of the company basically got 75% of the capital out of the business with investors and the commercial bank providing that capital, and then they rolled 25% into the company. Over the next 4.5 years, the company because the company becomes a qualified pension plan, just like your IRA, it doesn't pay federal income tax. Due to that strong cash flow the company had, we were able to pay off a 7-year loan to our senior lender. We paid it off in 2.5 years, and then COVID hit, and we got an unsolicited offer from a large health system. Many people think that an ESOP is a once and done thing. There are as many ESOPs being bought out of the ESOP structure every year as new companies going into the ESOP structure. There's about 7,000 ESOP companies in the country, everything from small $2 million EBITDA companies to Publix, which is the largest ESOP in America, Publix grocery stores. Because of the offer that was unsolicited, we had a valuation done that year that valued us at about 50% higher than what we did the ESOP at 4 years earlier. However, the offer from the large Catholic health system was 400 times what we did the deal at 4.5 years earlier. The board looked at the management team and they said, "We don't care. We're doing great. We'll continue to operate the business. But if you want us to do this, we'll do it." And we ended up closing in March of 2021. And in that closing, the employees split $40 million, 42 employees. And we had 13 of them got multi-million-dollar payouts. But even the ladies who did billing and collection, who were single moms, they were, they've been with us for years. They got $400,000 to $600,000 in their IRA accounts from that transaction. And some of the emails I got from the staff, I still tear up when I read them, because the appreciation of what we did for them was enormous.
Tom, I watched it firsthand. Fantastic to watch. Just a great blessing. I guess one last question. If you're an owner and you're listening to this or watching this, you're, pick a certain age. I hate to say these ages because I'm getting awfully close to them and lots of people are there. But whatever the age is, you're no longer your 30s and 40s. You're a little bit more senior as a business owner, and you're on the fence. What's the one thing you might tell them about an ESOP? Some of which people might not be that familiar with, because it's not been as used a vehicle the last decade as it was. It seems like a couple decades ago. But you do have things like Publix. You had Snyder Electric. You've had some great companies that have ESOPs. I saw you use it magnificently well with Regent Surgical Health, which is one of the largest surgery center chains in the country today. What's one thing you would tell people about ESOPs if they're on the fence and not sure about this as a strategy?
All companies are going to transact. It's either warm hands or cold hands. It's a fact of life. The question is, what's your strategy? What do you want to accomplish with that transaction? And our website, perpetuatecapital.com, has a feasibility study button in it. And if you'd like, I can copy that into the chat or into the questions, and people can click on that, and they can put their data into it and see what an ESOP transaction will look like financially, with all the cash and the tax savings, what the private equity transaction will look like with all the holdbacks and paying taxes, and a strategic analysis. And that way people, they can then make a somewhat more informed decision about at least which direction they want to put their emphasis in. We looked at all three. That's an expensive way to do it. But if you can eliminate one or two of them initially and just go down one road, it's a lot more efficient and a lot more cost effective.
Tom, I want to thank you. It's always brilliant to get to visit with you. One of the smartest business people I've ever had a chance to visit with. Also, one of the most ethical and highest integrity. Tom Malin, it's been my pleasure over the course of our career to work with Tom really closely on a number of different areas, and as good a person as they come. I'll do this. We've just got a few minutes left. Molly Gamble is joining us. She's the editor-in-chief of Becker's Healthcare, which is a media company that I founded a long time ago and only grew to be a great success because of the team that we built there and great leadership. Molly, Jessica, a whole bunch of other people that really grew that business. More recently, we wrote a book that's coming out tomorrow about building businesses. Molly's just going to ask me a couple questions about that. We promise we'll have everybody on their way in 10, 15 minutes. I want to do one more round of thanking our sponsors, McGuire Woods, Perpetuate Capital, Priority Search Management, ThinkSpan, Elevate Talent Advisors, ModMed, Jeff Friedman, Beard and Water, Warner, and Grage Park Partners. I want to thank all of you for your support. This has been, for me, a great pleasure getting to visit with so many people this afternoon, all in one swoop. So thank you so much. Molly, I'm going to turn it to you. Molly's the long-term editor-in-chief of Becker's Healthcare, vice president of editorial affairs. Fantastic. Co-author with me on the book, Building Great Businesses. Molly, I'm going to turn it to you.
Okay, thanks, Scott. Yes, we're on the eve of the book coming out tomorrow, Building Great Businesses, Create Momentum, Overcome Setbacks, and Scale with Confidence. So, Scott, you had a lot of thoughts that you channeled toward this book. I thought we could take some of the front page A1 concepts and share them and talk about them here. But you obviously have your experience with your businesses, but you also have been just such a sponge for learning from other business leaders around you. What are some of the most important habits you've really seen shine through from those who were successful at founding and building and scaling great businesses?
Sure. No, I really think always in terms of 3 or 4 things. Clarity of what you're trying to accomplish and what you're trying to do. Second is, we talk about this a lot, but nothing's done without great teams. I'm not a believer in the solopreneur concept. I'm a believer in teams. The third thing we think about is niche markets versus broad markets, and everybody's got their own opinion on this. The fourth thing I think about is really product market fit. Are you doing something that the market actually wants, or something that you just want to do? If it's something you just want to do, it's an advanced hobby. If it's something that people will pay for as well, then you've got product market fit. And in an ideal business, you really constantly know who your ideal customer is and who you're trying to work with. So we think about those things a lot. Real clarity about what you're trying to do, who you're trying to do it for, building great teams, almost always around niches, and really taking great care of your customers. Molly, thank you. Let's keep on rocking and rolling, and we'll encourage anybody that's got questions to ask questions. And again, we talk about in the book, overcoming setbacks. We've had plenty of them, but also have had some really, really nice successes, both in companies that we've built and companies that we've been on the board of, and investors of, and related to. So thank you.
Scott, before I move on to the next one, which is about founders' journeys, can you just, one other habit I think that you have been really persistent about is when it comes to naysayers. Can you just share a little bit about your thinking there? Do we lose that?
Sure. So no, I love that. And so there's 2 things I think about often, Molly, and I love that question, naysayers. Any business you really get going in, you are inevitably going to have somebody that tells you, you can't do that, it's too competitive, you shouldn't do it, for whatever reason. And so that's the first concept, is I'm a believer in ignore the naysayers, test your business, go after it, try and build it. In my experience, the naysayers have largely been wrong. Obviously, Becker's Healthcare became a really, really successful media company. And when I got going in it and really expanded into the hospital area, which became 90% plus of our company, I would have people tell me, you have no business getting into that area. It's too competitive. You can't do it. That, of course, became literally 90% of the company that ended up being a really successful company due to a lot of people and a lot of different leaders. But if I'd listened to the naysayers, I would have never gotten there. Similarly, there's this other concept. When I first got started, people had when I first started, it was a very small newsletter, and somebody who I know, a physician, said, I use your newsletter for toilet paper, and it's very easy to get discouraged and get down. And if you listen to the naysayers, the negatives, it's very easy to give up, and you have to decide at some point to ignore the naysayers and to push forward and grow. And that doesn't mean you keep at it forever if it's not working, but for us, it ended up working. We got past the naysayers and we grew. And quite frankly, in almost every business I've been seriously involved in, there's been naysayers. And at some point, you got to have a thick enough skin to ignore them. One of the things I love about the things Bill Ackman speaks about all the time on Twitter is, if you're going to be an entrepreneur, you better have a thick skin, because you're going to have periods of time when you need that. And that goes hand in hand with this concept of, ignore the naysayers, don't listen to the naysayers. I love that question. And we've lived it. Everything I've ever done, we've had people say, you're too short, you're too slow, you're too dumb, you can't succeed in it. And we've done fine. So I love the question. Thank you.
Thanks for speaking to that. Founders' journeys. This is when founders evolve from doing everything themselves to leading really great teams. And it doesn't always happen in one fell swoop. There's often stages to this. Sometimes those stages aren't always cleanly announced. You don't even, some founders, I imagine, don't realize it's occurring until they're ways in with their teams around them, Scott. But how did you see this evolution unfold for you? And what are the stages of it that so everyone can pay attention to as they look to scale a company and grow?
Sure. No, we see this a lot. And we see this in leaders, in founders, in CEOs. There's this concept, the old adage is that you chief bottle washer, cook, you do everything. And when you start a company, that's often the case. And then you get to the next level where you've started to hire people. And we always talk about 2X versus 10X evolutions. A 2X evolution is you've hired a lot of people. Some people, they're not necessarily better than you as the founder at what you do, but they help you leverage yourself. They help you get a little bit further, but you're still the limiting step. So phase 2 is you're no longer the chief cook, bottle washer, everything, but you still are the limiting step. Stage 3 is you've hired people to fill out all the various different leadership positions, the executive positions, and all of those people are now better at their particular job or leadership area than you are. And that's the point where a company could accelerate and become a 10X growth company versus a 2X growth company, because you're no longer the limiting step. I remember so many times of this being the case in our business. Molly runs a team of 30, 35 plus journalists. I could never do that. I just couldn't do it. I don't have the patience for it. I don't have the methodicalness to do it. She does it far better than I could ever do it. And that's far different than early on when I was writing everything or managing and following everything and micromanaging everything. Similarly, our CEO, Jessica Cole, is just magnificent. I can't do what she does. That's just the reality of it. And it's that point where you're no longer the limiting step on stuff and your people could accelerate without you. And we've got a lot of that throughout the entire company that you could really grow. It's when you go from 2X to 10X. We call it the 3 stages of evolution of a founder. And we say this as an employee, your job is to be indispensable. As a founder, as a CEO, your job is really the opposite. It's to build to such a place where you're dispensable, where the company could run and grow without you being the limiting step. And this is very hard emotionally for founders and CEOs. People could tell me it's not, but for most people it is, because you sort of want to be indispensable. But if you want to build a great company, you have to get yourself out of being the limiting step and past the spot of being into the spot where you are somewhat dispensable. So no, I love the subject, love the question. We talk about it often. We talk about it in the 3 stages of the evolution of a founder, but it's true for a CEO, it's true for a leader, it's true for a lot of things. Where you go from being everything's done yourself So you've got a team that can accelerate without you being the limiting step. And that's where companies really grow.
Mm-hmm. And leaders who mistake themselves and see them as being indispensable as their purpose and role, Scott, that's one way they can get in the way of a team or a company trying to scale. But what are some other big mistakes companies make as they move from growth to scale? What are some common pitfalls?
Yeah, there's so many, but I think about them as, like the best leaders I know do a really good job of constantly staying really aligned with their leaders and paying attention to making sure they're thriving and they're developing leaders that thrive all the way around them. When I see companies, there's a great story. I think it was the Stryker company originally that used to limit itself to 10% growth a year because they would get to because they didn't limit themselves to 10% growth a year, they would get to a spot where the marketing would outpace execution, sales would outpace execution, and it's very important for great companies that things go hand in hand, that you're able to grow and execute really well for your customers so that you're constantly building great teams. You're constantly taking great care of customers. We see it as, in the successes I've had, I've been compelled by trying to grow great things. In the failures that I've had, I've often found myself excited about getting to the next step without putting all the foundational blocks in place correctly, because I was too excited about just having a success versus building something great. So when I see people make mistakes, it's at the end of the day, they stop really remembering or minding the things that really make things great. And they're not necessarily pursuing greatness, they're pursuing just growth. One of the best CEOs I ever worked with is a CEO of UCLA Health, Janice Spiso. And she is the very best at constantly coming back to, are we doing great patient care? Are we taking great care of patients and safety and delivering great results for patients, and not losing sight of that for all the discussion about metrics like where we ranked on U.S. News and World Report or where are we at on this different stat? And I think that constantly coming back to very centeredness, very groundedness. Who are we trying to take care of? What are we trying to do? Do we have the right team in place? Do we understand our ideal customer? Are so important. And when I see people sort of lose sight of that and pursue growth and scale as opposed to greatness, I often see trouble. And so that's sort of one mistake that we see founders and leaders make. And I'm not immune to making those mistakes sometimes, that's for sure.
Mm-hmm, mm-hmm. You might have indirectly addressed, this is a question from Nicole Cable, which, Nicole, thank you for the question. I just made my way to the Q&A and I see it now. But Scott, Nicole had asked, when scaling a business rapidly, what is the biggest mistake you see leadership teams make regarding disciplined execution? Is there anything more you'd want to add to that thought that might address Nicole's question?
Yeah, I see I don't know if I have a perfect answer for it, but I see when people don't take care of their operations, their teams, their people, and keep this constant focus on, are we delivering what we have to deliver for customers really well? So, there's a trend in some businesses to try and get rid of the COO, as maybe that's an extra layer of management. I think that's the worst possible trend. I think making sure, I'm always a big believer you can grow great if you have the right team in place. Like, there's nothing worse in an organization than when sales get in front of business execution and development. And it's not that you're not constantly running this fine line between the two, but constantly building on execution, constantly building on really taking care of things and really growing the right team. There's times when business is so good, but you don't have the talent to serve it. You've got to be willing at those times to turn away business versus to keep growing when you can't service it and really take care of it well. I know we had a comment from Jeff Friedman about it's time to update this picture. And as I look at this picture that we have in the slide deck, Jeff, you're absolutely correct. It's time to update that picture. That might be from 20 years ago. I might look 12 in that picture. I apologize, but you are absolutely right. But Nicole, hopefully we answered your question. What I hate in organizations is when sales and marketing get ahead of execution too much and people don't have great clarity about what they're trying to accomplish.
Excellent. Thanks for taking that one, Scott. And thanks, Nicole, for the the question you added to our conversation here. Scott, we are making our way to the end of the questions that I was hoping we could cover in our time together, but there's a lot of lessons in this book. If you had to pick one that you wanted to leave the audience with today, what would it be? If you had to pick your A1 story here.
I think about so many different things. I'm a huge fan of those founders, those leaders that really know their own business. And this doesn't mean you have to be a micromanager, but great leaders, great CEOs, great founders, they know who their best people are, their best customers, their best profit lines, what works, what doesn't work. And they're very disciplined about doubling down on their best people, their best customers, their best priorities, and they really know what they're trying to accomplish. I mean, it sort of comes back to the first concept on most important habits, but it's great clarity. Here's what we're trying to do with this. And when I've had great success in business or watched people with great success, I mean, he's on the webinar today, Todd Malin. I had a front row seat to him building with great integrity a surgery center company, and he always knew what was going on from location to location, people to people. He was loyal to a fault, but in the big scheme of things, that served him really, really well. And I look at leaders that really know their own businesses, they really know their own people. And I see so many leaders that get just so distracted by the noise out there. The best health system leaders today are not constantly harping on there's going to be a reduction in increases in Medicaid over the next 10 years. They're more focused on their own business. The best businesses I see at doing what they're doing, they're aware of what's going on around them, but they're really focused on, are they taking great care of their partners, their customers, their people, and more. So I'm just a huge fan of really knowing your own business. And there's the great, Kenny Rogers song that you got to know when to hold them, know when to fold them, know when to walk away, know when to run. And the best CEOs also know when, and this isn't about selling the business, but they know when it's time for them no longer to be CEO, because either there's another person who's ready to do it and can do it better, or their energy level's not in the right spot. But we do come back to, if I think about one thing, one lesson, it's really knowing your own business really well. And that means the people, the customers, the profits, the revenues, and what makes the business really go, and being able to an extent to filter out the noise and ignore the noise. I want to thank all of you for joining us today. I want to thank our sponsors, everybody from McGuire Woods, Perpetuate Capital, Priority Search Management, ThinkSpan, Beard & Warner, Elevate Talent Advisors, Grange Park Partners, and finally, ModMed and Jeff Friedman. Thank you all so much for joining us. What a great pleasure. And Molly Gamble, thank you as always for everything that you do and for jumping on here to interview me for the last 10, 15 minutes. Molly gets so sick of hearing from me, so I'm so thankful for her stepping in. Thank you so much.
My pleasure, Scott. This was fun. Thanks.
The other thanks I'll give to Rosa, Mackenzie, Michelle Robson-Byers, Madison, as well as Raiden. Thank you so much for all of your help in helping us put these on. Thank you for listening to the Becker Business and the Becker Private Equity Business Leadership Summit. Thank you very much.